Now that we've learned about zoning and about trend, let's combine the two. In this lesson, we'll give an overview of the strategy for finding a zone in a trend. What we want to think about is this: how do we find the correct formation in the correct location? In other words, we want to learn to find the right base in the right place. We're like writing a country song here. Finding a zone in the right location within the trend sets us up with a higher probability opportunity. Why is that? Well, we're looking to time the turning points of price in the markets. One element that turns price is a supply or a demand zone, where there's a big imbalance between buyers and sellers, and unfilled orders were left behind. Another element is the trend, because it provides an anticipated turning point. For example, a downtrend is made of lower highs and lower lows. So price is therefore expected to turn at a lower point than the previous high. With the expectation of where price is likely to turn from a trend perspective, and combining that with a quality zone, this not only provides us with a low-risk entry point, but also increases the probability of price turning at that zone. Trend indicates the direction of the large flow of money in the markets, the path of least resistance. We want to follow in the path of least resistance. In this way, the trend direction indicates whether to go long or short. If we identify an uptrend, this shows institutions are buying, paving the way for price to move higher. If institutions are buying, then we want to look for buying opportunities, demand zones. If we identify a downtrend, this shows the opposite. Institutions are selling. So we look for a supply zone to go short, joining the downward movement of price. In a sideways trend, there's opportunity in both directions. A sideways ranging market is showing us that price is stopping at the highs and the lows, so we can look for supply near the highs and demand near the lows. The key point is that trends tend to continue. Think about that for a moment. We're in the business of buying low and selling high. We do that by being right on the direction of price. Now there's already a direction in play, the current trend, and trends tend to continue. So the highest probability opportunity will be to join that direction. Proper trend identification not only indicates which type of zone to look for, but also shows where to look for that zone. In other words, it shows the location within the trend to look for an entry zone in the breakout segment of the trend. This simplifies our process and keeps things efficient. Think of it this way. If all you had to do was find a zone and you had no anchoring point from the trend, you could end up with 10, 20, 30 zones. What you'd really end up with is analysis paralysis. Because how do you choose between 20 zones which one to trade? Narrowing our focus to looking within the breakout segment to find a zone of entry eliminates much of the guessing game of which zone to trade, keeping things simple for us. In this lesson, we've previewed the strategy for combining trend and zone. Next, we'll get into the specific details for finding an entry zone within each trend, up, down, and sideways. In this lesson, let's talk about the basic buying strategy in an uptrend. An uptrend signals that big banks and institutions are buying, and in doing so, they're controlling a certain price level, the higher lows. So the direction to trade in an uptrending market is to buy long, and where do we buy long? That's right, at or inside a demand zone. Thus, in an uptrend, we look for a demand zone. But we don't just look anywhere on the charts for the demand. Where the demand zone is located in the uptrend is critical. Think of this. For any zone that is below the controlling swing low of the uptrend, price would need to cross that controlling swing low to reach that demand zone. And by crossing the swing in control, the trend would be terminated at that point. We don't necessarily know if the trend would be down or sideways at that moment in time, but we know what the trend won't be. It won't be an uptrend. What this means is the controlling swing low is the anchoring point for our entry zones, and we can narrow our focus to the breakout segment to identify demand zones. To put it simply, once an uptrend has been identified, our action is to buy at a demand zone located within the breakout segment of the uptrend, above the controlling swing low and below the most recent swing high. Now remember when we went through the trend identification process to find an uptrend, we related the trend boxes to our formations. The combination of green, red, green kind of looks like a rally-based rally, right? And that's what we'd typically find if we were to bump the time frame up high enough, because the candles would sort of melt together into an RBR formation. We're not getting into time frames yet though, so let's go back to our formations. What do we do with a rally-based rally? The action is to buy as price retraces to the base of the RBR. Well, we can apply that here as well. Notice that we have a rally-based rally demand zone in the breakout segment, below the most recent swing high and above the controlling swing low. By implementing this simple strategy, you'll be weeding out zones which have a lower probability of success. Now let's not forget all that we learned about quality zones. In the 5-step zoning process, we test the quality of the zone structure of the demand zone with the odds enhancers. Looking within the breakout segment of this uptrend, we have a fresh demand zone that has a move out of at least 2 to 1 that breaks out above the preceding high and not too many basing candles. Let's jump ahead and see what happens. You can see that as price comes back to the zone, it turns, creating the next higher swing low of the uptrend and continues past the preceding swing high. Now you know the basic strategy for buying in an uptrend. Confirm the uptrend and identify a quality demand zone within the breakout segment. It's as simple as that. In this lesson, we'll show you the basic selling strategy in a downtrend. A downtrend demonstrates that big banks and institutions are selling. If they're looking to sell, we should be looking to sell, which means we want to look for supply zones. The strategy in a downtrend will be the exact inverse of the uptrend. Remember, the termination point of the downtrend is when the controlling swing high is crossed. That's the line in the sand. For this reason, we will not be looking for supply zones located above the controlling swing high. Because though these supply zones may have formed in a downtrend, price wouldn't still be in a downtrend when it gets there. This means that we need to look for supply zones at or below the controlling swing high of the downtrend in order to join the trend. In previous lessons, you learned how to confirm a downtrend by starting from current price, identifying the 3 or 4 most recent segments on the chart, and verifying the downtrend, a high, a low, a lower high, and a breakout below the low. Once you confirm the downtrend, it's time to identify a quality supply zone. Can you see how our red and green segment boxes kind of look like a drop-based drop? If we were to bump the time frame up high enough, that's what we'd see. The candles would melt together and we'd typically find a DBD formation. So what do we do with a drop-based drop? The action is to sell at the base of the DBD. We can apply that here as well. Notice we have a DBD supply zone located within the breakout segment of the trend, above the most recent swing low and below the controlling swing high. This is the prime real estate of the breakout segment, the area of that red box that falls within the base, if you will, of the DBD that is created by the trend boxes. Looking at this example, we have a downtrend. Going through the 5-step zoning process, we find here we have a drop-based drop, one of the supply formations. The question is the formation in the right location? We see the zone is within the breakout segment, below the controlling swing high and above the preceding low. So, check. The base is in the right place. Considering our zone structure odds enhancers, the zone has a strong leg out of at least 2-to-1 that breaks out below the preceding swing low. Price doesn't spend much time at the zone, and the zone is fresh. Let's jump ahead and see what happens. You can see that price reverses at the zone, creating the next lower high and moves to lower lows. Now you know the basic strategy for selling in a downtrend. Confirm the downtrend and identify a quality supply zone within the breakout segment. Following this simple process will keep you focused on quality setups with the best potential. In this lesson, we'll show you the basic strategy for trading in a sideways trend. The big question is, where is price going to turn? In an uptrend, the tendency is for price to turn up somewhere above the controlling swing low. In a downtrend, price should turn down somewhere below the controlling swing high. So what we've learned so far is that we anchor our entry points off of the lows and highs respective of the trend direction up or down. What about a sideways trend? What's the tendency here? In a sideways trend, we see the market contained within a range. Price oscillates back and forth between the highs and lows. So where does it turn lower? At the top of the range. And where does it turn higher? At the bottom of the range. This means when you identify this type of price action, look to sell at supply zones near the highs of the range and buy at demand zones near the lows of the range. Typically, the segments in a sideways trend are relatively equal in height. With that in mind, once we've identified a sideways trend, we want to look for supply zones at the high end of the major down segment, and we want to look for demand zones at the low end of the major up segment. One thing that's particularly important to consider with a sideways trend is how wide the range is. The reason for this is because the profit potential for trades in a sideways trend will be the boundaries of the range. So we want to set the expectation of profitability accordingly. If the range is quite narrow, then the profit potential wouldn't be that great, and we may not want to enter a trade there. We may want to wait for a breakout of the range before getting involved. However, if the range is wider, then there would likely be sufficient profit potential when trading at the extremes. Now you know the basic strategy for trading in a sideways trend. Confirm the sideways trend and look for quality supply near the highs and quality demand near the lows. In simple terms, in a range, we trade the extremes. We'll get into more details on timeframes later down the line, but as a general rule, the entry zone should be found on an equal or lower timeframe than the trend timeframe. We can expect to find the lowest risk zones by looking 3 to 4 timeframes lower than our trend timeframe. Let's take a look at an example. We've identified an uptrend on the 60-minute chart, but there isn't a quality zone visible in the breakout segment on this 60-minute time frame. But if we take this chart down to a 15-minute, the candles break apart and reveal a quality demand zone. It has solid zone structure, and it's within the breakout segment of the uptrend. When price comes back to this demand zone, we see price turn at the zone and rally out of there, continuing the uptrend. Well, this wraps up the strategy for each trend: uptrend, downtrend, and in this lesson, sideways trend. Using these segment boxes will help you paint a clearer picture of what price is doing and help define the controlling swing high or low. This visual points out the breakout segment of the uptrend and downtrend. And of course, with the sideways trend down here, there are no breakout segments. As you've probably figured out by now, having a process is critical to trading. These simple steps will create good routines and discipline, which will carry you throughout your trading career. Now that we know how to classify trends, our next step will be scoring trend as an odds enhancer. In this lesson, we're going to look at how trend works as an odds enhancer for supply and demand zones and why following the direction of the trend can increase your profit potential. Trend is an odds enhancer because it represents the direction of price movement. It can be up, down, or sideways, and a trend tends to continue in the direction it's already going. So if we have an uptrend and assume that it's likely to continue, it makes sense to buy or join that direction. If you sell against that direction, the profit potential is low because it's much harder for price to turn in a supply zone when it's part of an uptrend. And even if it turns, it's not likely to give you a big drop. A trend is like a river moving in one direction, and it's easier to just go with the flow. Why struggle against the current? You have control over the way you trade. You can buy first and look to profit as price goes up, or you can sell short first and look to make money as price goes down. Whichever way you choose to trade, it makes sense to follow the direction of the trend. Let's look at how trend is scored when selling at a supply zone. Selling in a downtrend is going with the flow of the trend, so that's a good start. Remember, the zone needs to be in the breakout segment to truly join the trend. If it is, your potential for profit is greatest, and the zone gets a 2, the highest score for trend. A supply zone at the high end of a sideways trend has some profit potential and gets a score of 1. If you're thinking about selling at a supply zone in an uptrend, think again. The zone gets a score of 0. There's typically just not much potential for profit. Now let's see how to score trend for a demand zone. Buying in an uptrend is going with the flow of the trend. A demand zone in the breakout segment of an uptrend provides the greatest potential for profit, and the zone gets a score of 2. A demand zone at the low end of a sideways trend has some profit potential and gets a score of 1. There's not a good probability that price will turn from a demand zone in a downtrending market, and even if it could, there isn't much potential for profit. So a DZ in a downtrend gets a score of 0. The lesson here, go with the trend. Going with the dominant direction of the trend increases the probability of price turning at the zone. Now to continue scoring our trade, for our working example, we've already scored for strength, time, and freshness. To check the trend, the time frame gets bumped up and the zone looks slightly different as the candles melt together a bit, but nonetheless, it's still the same zone. You can see the chart is in an uptrend, higher lows and higher highs. Would price turning at our demand zone continue the trend direction? In other words, would it continue the pattern of higher lows and higher highs? Yes. So when price comes back to that zone, we would buy with the expectation that price will turn and create the higher low here. Since this is in an uptrend and our buy point is at the most recent swing low, this would receive 2 points. As we update our scorecard, we're going to add 2 points for the trend, which brings us to 7 points out of a maximum of 10, and we still have 2 odds enhancers to go. This trade is starting to look pretty good. Now you know how to test and score a supply or demand zone using the odds enhancer for trend, a key piece to add context to the trade. We've explained the trend and how to locate an entry zone to join the trend. We also talked about how to set the trade stop, entry, and target for the entry zone and consider the reward to risk ratio for the trade. In this lesson, we'll show you how they all come together to create the buy and sell setups. Let's review the trend stages we've already covered: the uptrend, the sideways trend, and the downtrend. Starting with the uptrend, our focus is to buy at demand zones within the breakout segment. Ride that trend out through the impulsions and corrections and let the profits run. With a sideways trend, our profits are confined to the boundaries of the sideways range. In a sideways trending market with a tight range, there's probably not enough room for profits to make it worth our while. Instead, we'd wait for a breakout, either up or down, that would move into an uptrend or downtrend, and we can follow that trend and let profits run. If the sideways trend has a wider range and offers enough profit potential to make the trade worthwhile, we can trade within the trend by buying at the low end of the range and selling at the high end. Lastly, in a downtrend, we want to short at supply zones within the breakout segment of the trend and ride the trend through the impulsions and corrections for greater profits to the downside. Now for the buy and sell setups. While we have opportunity in sideways trends, in this lesson, we're going to look at buying in an uptrend and selling short in a downtrend. Let's start with the buy setup. First, once an uptrend is identified with low, high, higher low, and a break of the high, then we identify a demand zone for entry using the 5-step zoning process. Of course, making sure that demand zone is located within the breakout segment of that trend, within the impulsion phase that's connected to the controlling swing low. By using the 5-step zoning process, we're incorporating our zone structure odds enhancers as we identify the zone. We're looking for a strong move out of at least 2-to-1 that breaks out above a preceding supply zone, a zone that doesn't have too many candles at the base and is fresh. Once we do that, we need to find our target zone. If we're entering at demand, our exit is going to be supply. So we find the nearest opposing supply zone and set up our trade. We'll buy when price drops into the demand zone, that's our entry, placing a stop below the distal line of the demand zone, and finally, place the target beneath the target zone, the nearest opposing supply zone. Now let's look at the sell setup. First, the trend must be identified. Once you have a downtrend, high, low, lower high, and a break of the low, then we can look for a supply zone to join the direction of the imbalance. We identify a supply zone using the zoning process, which of course incorporates the zone structure odds enhancers. We specifically need a supply zone within the breakout segment, that most recent red box that's linked to the controlling swing high. Then we find our target zone. If we're entering at supply, then our exit will be at demand. So we'll find the nearest opposing demand zone to base our profit target off of. Now it's time to set up the trade. We'll sell short once price rallies into the supply zone, placing a stop loss above the distal line of the supply zone, and finally, we'll place a target above the proximal line of the target demand zone, that nearest opposing demand zone at the bottom. Now you know the steps for the buy and sell setups. Both include identifying the direction the market is trending in, finding a quality zone to join that direction, and finding a target zone to base our target on. From there, it's setting the trade and taking it. So let's go find some quality setups. In this lesson, we're going to talk about the 3 elements of every trade: the entry, the stop, and the target. Let's begin with the entry. The entry is the act of opening a trade or opening a position in the market. A good entry is one with a great profit potential, a low potential of risk, and a high probability that the trade will happen and work in your favor. The exit is the act of closing or getting out of a trade, sometimes referred to as closing a position. A proper exit is pre-planned, disciplined, and unfortunately often overlooked since most people are more concerned with the entry. The exit requires special consideration because it carries an extra element to it, emotion. Think about it. Every time the price of a trade rises or falls, you're either making money or losing money. If you're making money in a trade, that greed emotion can take over and you face the decision of get out now and take profits or stay in and try to gain more profit out of the trade. If you're losing money in a trade, the fear emotion sets in and you're faced with the decision of get out now and cut my losses or stay in the trade and hope it comes back to profitability, but yet risk losing even more. The last thing you want is to let your emotions dictate your trading. That's not the formula for success. To avoid this, your exit needs to be pre-planned and you must have the discipline to follow through with it, whether you exit the trade for a profit or a loss. The stop loss is the order to exit the position for a predefined loss. Keywords: predefined loss. This allows you to know the worst case scenario before you even enter the trade. Before the trade happens, you determine an amount that you're comfortable with losing. Not that we ever like losing, but remember, you have to risk money to make money. It's a normal part of trading. Your goal is to not risk frivolously, emotionally, and unplanned. The amount should be based on your risk tolerance and the size of your account, a number that makes sense for you. The stop loss is critical. It measures the risk of the trade and permits small losses instead of large ones. You can handle small losses. It's the big losses that are not only damaging to your account, but also to your mindset. So when you exit the trade at your stop loss and you've lost a little money, don't think of it as a failure, but rather as part of the game, part of trading. Kind of like the cost of doing business. There's no risk-free trade. Sometimes it's just going to happen. You will lose on some trades, and you want to be prepared for that and comfortable thinking in terms of probabilities. The target is the other possibility for our trade. The profit target is the order to exit the position for a gain. This is also critical to your trades because, again, trading can get very emotional, and if you don't have your profit target set up with a plan to exit the trade profitably, that little greed monster is going to pop up and encourage you to go for a little more, and then a little more, until price starts to come back against you and you'll wish you had gotten out. But now you're crossing your fingers, hoping it'll come back. You promise yourself you'll get out at where you should have the first time, if only it'll just come back again. And the next thing you know, price is at your zone again, and you're now just hoping for break even at best. Don't you see how emotional it can get? Even in profits. You've got to have these elements planned out. Your profit target measures the reward of the trade. You can have multiple targets as well, which permits small and large gains based on market positions. Once again, the key is having a predefined plan. So now you know the 3 elements of every trade. A good way to remember them is that all trades need to be set up with a stop, an entry, and a target. And more importantly, remember that all 3 need to be pre-planned and you must have the discipline to follow that plan. Plan the trade and trade the plan. Keep it simple. In this lesson, we're going to look at a quick overview of 3 different entry types. As you begin mapping out your trades, it's important that you know which entry to use and when. Once a trade has been identified, not only do you need to set the trade, deciding the prices for entry, stop, and target, but also the way you'll enter the trade or the type of entry. Our strategy can include any one of 3 entry types for long or short positions. Our first entry type, or number 1 entry, is the proximal entry. It's named as such because we look to enter the trade at the first touch of the proximal line when price retraces back to the zone. That's sometimes referred to as a limit entry because you'll be using limit orders to enter the trade. Second, the number 2 entry is the zone entry. It's named as such because you'll be looking to enter the trade somewhere inside the zone. So not at the proximal line, but somewhere between the proximal and distal lines. Depending on how you want to do it, both limit and market orders could be used. Finally, we have the number 3 confirmation entry, which would be close to the same price as the proximal entry, but a different moment in time. We're waiting for price to come back into the zone, turn around and confirm that it's switching directions. Then the trade would be entered as price is making its way out of the zone. Confirmation entries are a bit more challenging from an execution standpoint, as you'd have to use market orders if you were watching the trade, or use stop orders as a fancy entry if you were looking to set the trade in advance. We'll look at these a little later. The goal is to find the right entry to allow you the maximum reward with the minimum amount of risk. As you'll see shortly, each of these 3 entries has some advantages and disadvantages. Let's dive deeper into entry type number 1, the proximal entry. With the proximal entry, we use a limit order. So once a demand zone has been established, after price has rallied out of the base here, we would place a buy limit order at the proximal line price. Then wait for price to come back down. As soon as it touches the proximal line, that's when the order can be filled. For a supply zone, after price has dropped out of the zone, we would submit a sell limit order at the proximal line price. Then we wait for price to come back to the zone. As soon as it touches the proximal line, that's when the sell limit order can be filled. Let's look at an example for demand. Here we can see a demand zone on the oil ETF USO from 1083 to 1078. So with those numbers on our chart, we map out the entry. As of this moment in time, price is well above our desired entry price. So we place a buy limit order at the proximal line price of 1083. 2 days later, USO opened the trading day and fell quickly to the demand zone, triggering the limit order, entering a long position at 1083. And then price proceeded to rally to the upside. Check out this supply zone on the NASDAQ 100 ETF QQQ from 161.32 to 161.11. Since price is currently below our desired entry, a limit order to sell short is placed at 161.11, the proximal line. When price runs back up to our supply zone, it triggers our short entry and then immediately begins to fall. How great when it works like it should. In this lesson, you learned more about the proximal entry and saw what that looks like for both demand and supply. Let's take a look at the number 2 zone entry. Zone entries can use both limit and market orders. Instead of buying or selling right at the proximal line, we'll wait for price to move deeper into the zone. In a demand zone, we submit a buy limit order at a price inside the proximal and distal lines, or a market order as current price is inside the zone. In a supply zone, we place a sell limit order at a price within the zone, slightly above the proximal and below the distal. If using a sell market order, we send it while current price is at a price inside the zone lines. The choice on when to use limit and market orders is up to each individual trader. In this example, we have a supply zone on the healthcare ETF XLV. This puts our supply zone between 93.17 and 93.64. Since price is currently a fair distance below our supply zone, we will use a limit sell short order in the middle of the zone at 93.45. Several days later, price works its way back to our supply zone, entering the zone and hitting our short entry. If you were using a market order, you would need to be at your computer waiting for price to enter the zone. For a demand zone example, check out this DZ on the Energy ETF XLE with proximal and distal lines at 67.72 and 67.39. In anticipation of price returning to the demand level and bouncing back up, we put in a limit buy order at 67.50, around the middle of the zone. Shortly after, price sells off and retreats to our demand zone, filling our limit order at 67.50 before resuming the trend to the upside. You now know what a zone entry is and how to use it. 2 entry types down, 1 to go. In this lesson, we're going to look at our final entry type, the number 3 confirmation entry. With confirmation entries, we wait for price to come back to the zone, reverse direction, and begin to exit the zone, and that's the point where we enter the trade. In a demand zone, we wait for price to drop into the zone, turn, and cross above the proximal line to buy. In a supply zone, we wait for price to rally into the zone, reverse, and cross below the proximal line to sell short. For an example of what this looks like on the demand side, we have a zone on the 20-year bond ETF TLT between 120.81 and 120.91. For this entry, we wait for price to drop into the zone and turn. As it exits and breaks back above the proximal line, that's the moment you try to enter. To do this, you can send a market order as price breaks above the proximal line, or you can use a stop order, which we'll talk about in future lessons. The next day, price dropped down to the zone, and we would have entered long right as price broke back above the proximal line highlighted here. Also on TLT, here's an example of a supply zone between 121.28 and 121.17. With the zone on the chart, we wait for price to return to it, enter inside it, and then turn to the downside, confirming that supply exceeded demand at the zone. After going into the zone, we will use a market sell short order as price crosses below the proximal line, or a stop sell short order could be used. As you can see, the next day price gaps up and continued to rally right into the supply zone. Once price dropped out of the zone below the proximal line, we would enter short. You now know what a confirmation entry is. There are advantages and disadvantages to each entry type, and as such, they cater to different situations and market conditions. For now, we will focus on using proximal entries for our execution. Don't worry, we will go into more depth later in the course on when to use zone and confirmation entries and the pros and cons of each. In this lesson, we're going to show you two components of an exit which must be utilized in every trade. Just like a watch functions because all parts are working together, so do your trades. All parts of the trade need to be considered before you fire off any trade. Those basic elements are the entry, the stop, and the target. The exit side of that trio is the stop, the predefined maximum risk we're willing to take on the trade, and the target, the predefined profit we're looking to make with the trade. Decisions about a trade and its management should be made prior to placing the order because that's when we're the most objective. Once an order is placed, or rather, once we're in a trade, we become biased as we naturally want the trade to work. So it's a simple fix. Pre-plan your initial stop, deciding on the maximum loss you're willing to risk on the trade, and your target, the revenue or profit you're planning on making in the trade based on what the chart is offering you. Exiting a trade for a loss is not something we want to do, but if the plan doesn't work out, we must get out. Here we have an example of a short trade where we anticipate price reversing direction and heading down if and when it retraces back to the zone. We will know that the supply zone didn't work once price breaks above the distal line. Therefore, we will place our stop loss, a buy-stop market order, above the distal line of the supply zone. For demand, if we buy to enter the position, we'd sell to close it at a predetermined loss point. We use a sell-stop market order just below the distal line of the demand zone. For when the trade works in our favor, we will be using limit orders at the predetermined profit target price. At the supply zone at the top here, if we sold to enter, then we'll buy to get out. The target should be set above the opposing demand zone down here. So we place a buy limit order to cover our short position just ahead of the DZ. And for going long at demand, we set the target, a sell limit order, just below the opposing supply zone here to take profit. So in summary, we always set the trade with stop, entry, and target prior to entering the position. For selling short, entry is a sell limit order based on the proximal line of the supply zone. The buy stop market order goes above the distal line of the supply zone, measuring the risk on the trade. And finally, we set our target, a buy limit order, before the opposing demand zone, defining our potential reward. For long, just flip all of that upside down. Entry is a buy limit order at the demand zone. Our initial stop is a sell stop market order below the distal line. And for target, we will be using a sell limit order below the opposing SZ. A stop always goes just beyond or outside the distal line. If we're going long, the stop goes below the demand zone. If we're going short, the stop goes above the supply zone. In this example of a long, we have our number one entry, the limit entry, right on the proximal line. We set the initial stop just below that, and our target is set up here, just in front of the opposing supply zone. There are some important considerations to make with your exit strategy. First, just to reiterate, always make sure you have a clear, pre-planned stop and target. Take the emotional trading out of the equation and stay objective. Secondly, make sure your potential profit is worth the risk you're taking. A good rule of thumb is a target set at least at a 3-to-1 reward to risk ratio. Doing this will give you a cushion for your account to weather the small losses. The third consideration is to exit the trade, or at least some of it, before the competitive buying and selling begins. To put that into perspective, if we're going long, our profit target is a sell order. If we were to set our profit target at the prices of a fresh supply zone, where we know there are institutional sellers, we'd be fighting with them to get our sell order filled. Instead, place the target just in front of them. Don't get greedy. And finally, we can manage a trade by moving the stop market order, but only in the direction of profitability. You'll learn more about that when we discuss trade management. Here's a short setup at this drop-based drop supply zone. Entry is at the proximal line and stop outside the supply zone. The initial obvious target will go in front of this opposing demand zone. But as we look at this, can you see any trouble spots between our entry and our target? Right in here, we have an opposing demand zone. Though it's not an amazing demand zone, we need to take seriously any threat to price dropping in our favor. To mitigate risk in that location, we place a first target before that. If the market reverses there and moves back towards the stop, we'd have a profitable or break-even trade by having a target here. Of course, we'll make a little less money by the time it hits our second target than if we had closed the entire trade at that second target, but we have to respect each opposing zone as a threat to our trade. Remember, it's important to set our targets in front of opposing zones and make sure that the reward to risk is sufficient enough for your trade plan, in this example, 3-to-1. Now you know the two components of the exit, the stop and the target. Exiting a trade for a loss is never desirable, but it is necessary to avoid taking large losses. Those large losses can destroy your account and potentially your trading career. And of course, we all want to exit for a profit. That's why we're trading. As we progress, stops and targets should be integrated into every trade you make. Though we've defined reward to risk ratios before, in this lesson, we'll take a deeper look as to why they're key to your success as a trader. The reward to risk ratio is simply the amount of profit you stand to earn on a trade compared to the amount you could lose. It's important to evaluate this prior to taking a trade to determine whether or not the potential payout is worth the risk. You'll decide on a minimum for your trading plan, but keep in mind what's important is that the combination of your average reward to risk and winning percentage is what gives you a positive account or not. A good place to start is with the goal of a reward to risk ratio of at least 3-to-1 on your trades, meaning the reward the trade offers is 3 times the amount of risk. Why is this so important? Let's look at an example. Say a trader makes 4 trades. Each trade risks $1 with a potential profit of $3 per trade, a 3-to-1 reward to risk ratio. The first trade is a loss, so we're 0 for 1. The second trade is another loss, down another $1, and the winning percentage stays at 0%. The third one is another losing trade, we're 0 for 3, but the fourth trade, however, hits the target and results in a $3 profit. After these transactions, the trader was only successful 25% of the time, yet they are still break even. What's important to understand is that the loss side isn't flexible. There's no wiggle room. To keep within this probability model, you have to have fixed risk. You can, however, have variable reward. You could go for 3-to-1, 4-to-1, 10-to-1, or even higher. Remember, you just need to make sure the reward to risk and winning percentage combine for a positive P&L. Check this out. Which of these 2 types of win ratio equations do you think make a better trader? The top one combines 70% wins with a low reward to risk ratio, and the bottom one is a 30% win rate, remember that's losing 70% of the time, with a high reward to risk ratio. Surprisingly, it's the trader with less wins and a higher reward to risk ratio that will ultimately be more successful in the long run. To make this work, you want to target trades that offer a minimum reward to risk ratio of 3-to-1, and if it can be even greater, say 5-to-1, even better. Also, if you plan on intraday trading, consider reaching your objective or profit target within the day's trading session. Let's look at an example on XLE, the ETF for energy. The demand zone is from 61.50 to 61.41. And you can see the price has come down and touched the zone several times, clearly a hot area. At the top, we mapped out a supply zone based on past levels. In a perfect world, we'd love a profit potential of 20-to-1. I mean, anything in the 20s is a phenomenal rate of return. Since this is set up as a potential day trade, however, there's a low likelihood of reaching that full reward to risk potential. For a better chance at hitting the target within the regular trading hours of the trading day, set a predefined target or multiple targets that give you the chance of hitting 3-to-1 within the day. Here you can see the 2-to-1 mark, 3-to-1, 5-to-1, and 8-to-1. Now you have a basic understanding of why reward to risk ratios are so important to your success as a trader. You'll be assessing reward to risk ratios for every trade you make. In this lesson, we're going to talk about bracket orders. Many traders dream of putting some trades on and then going hiking, shopping, golfing, traveling, or just enjoying life, all the while not worrying about their trades. Well, this is not a dream. It is simply using something called a bracket order. A bracket order is an order that has an entry, stop, and a target all set at the same time. It's an entry order bracketed with a stop and a target. A bracket order accomplishes 3 things at once. It sends an order to open a position, and once it's filled, automatically sets your stop loss and target. Many traders call these set and forget orders because once you set it, you can go about your business knowing your stop and target are in place. If your platform allows it, you'll use a bracket order for almost every trade you make, allowing you to manage all aspects of the trade with one button. There's a little learning curve here, but after a bit of practice, they'll become easy to use. A bracket order consists of two pieces that are basically two sets of instructions. The first set is the OSO, or order sends order. If your entry order fills, then you'd want a stop and a target bracketed around that, but not unless you get filled on the entry. So with OSO, it says once the entry order is filled, that order filling sends the exit bracket for the stop and target. It's also referred to as one sends the other. The OCO, or order cancels order, is the second set of instructions. The OCO ties the two orders together, the stop and the target. If the target order is filled first, then the stop order is canceled. If the market moves against the position and the stop loss is triggered, then the target is canceled. If one is filled, the other is canceled. So now you have a basic understanding of how bracket orders function. They are designed to help remove the human emotion aspect of trading by letting you put in all the variables for your stop, entry, and target before ever entering the trade. In this lesson, we will look at a bracket order when going long. With a bracket order, it all starts with our entry. This can be done with a market or limit. To protect the position, we will also input a stop loss. We add a stop market order at a price below our entry. And finally, if the trade works in our favor, we place a sell limit order above current price to have a target set where we will take profit. In this example, we have a supply and demand zone. To plan a long entry at demand, our first step is to place a buy order at our desired entry price, a buy limit order at 34.30. The second step is to map out our stop loss with a stop market order just below the demand zone at 34.15. Finally, for the target, we set a limit sell order just below the opposing supply zone at 35. Once we hit the send button, the entry order will be sent to the market with the other two orders, the stop and target, waiting to be sent. Now let's say price has fallen into the demand zone and our limit buy order fills. We will now be long this security at 34.30. Then the system will automatically send out the stop and target, the OCO portion of the bracket order. It's an OCO order because if price rallies to 35 and hits the profit target, the stop order will automatically be canceled. And if price falls to the stop loss of 34.15, then the target order would automatically cancel. Either way, we're protected. Now you know how a bracket order works for a long position. Next, let's look at how it works for a short position. In this lesson, we will break down the steps to create a short bracket, selling high and buying low. For order sends order, it all starts with our entry, which could be a market order or limit order. For the exit, since we sold first, we buy to close the position. To protect the position, we input a stop loss using a buy stop market order at a predetermined price above our entry. And finally, for the case that the trade works in our favor, we have a target set using a buy limit order below current price. Let's look at an example. Here you see a supply and demand zone. We anticipate that if price retraces back to this supply, it can reverse directions at the zone. So our first step is to place a sell short order at our entry price, 34.85. Now to create the bracket order. Our second step is to place a stop loss with a buy stop market order just above the supply zone, in this example at 35. Lastly, we set the target with a limit buy order just above the opposing demand zone at 34. Once we hit the send button, this whole little order egg with 3 parts in one will be sent off to the market. One thing to note when entering a short position, it's labeled as sell short rather than just sell. And when exiting a short position, it's referred to as buying to cover rather than just buy. When exiting a short, you're buying to cover what you've borrowed. This distinction in nomenclature is only made with equities, not with the other assets. Long story short, see what I did there? When selling short, your entry is sell short and your exit is buy to cover. Now, if and when price hits our limit sell short order and fills, we will now be short this security at 34.85. Once that happens, the system will automatically send out the OCO portion of the bracket. If price falls to 34 and we exit the trade for a profit, the stop order will automatically be canceled. If instead price rises to our stop loss of 35, the target order would automatically be canceled. Either way, we are protected. Now you know how a bracket order works for a short position. Having a plan is mission critical when it comes to trading and investing. In this lesson, we'll give you a broad overview of the trade plan blueprint, which outlines the components of a trade plan. At this point, you should have a good understanding of zoning and trend concepts. So now it's time to start building a professional trade plan. The trade plan blueprint outlines key elements necessary to set up and follow through on all your trades and investments. The trade plan blueprint has 2 categories: occasional steps and recurrent steps. Occasional steps are what they sound like, things you need to do and review either annually, quarterly, or monthly, depending on your style of trading. The occasional steps will be revisited more often if you are a short-term trader versus a long-term trader. In any case, the occasional steps include defining your purpose and duration, your trading style, setting risk rules and reward goals, creating a watch list you can refer to, and most importantly, reviewing your results. Because anything that's tracked improves. Unless you go back and see how you're doing, you won't be able to keep improving and make any necessary adjustments. Next, let's look at the recurrent steps, the steps taken before, during, and after every single trade. Before you begin analyzing the charts, you will go through a couple of pre-steps. Once through this pre-market routine, you'll work through a 6-step process to plan a specific trade or investment. This process includes setting the curve, checking the trend, identifying entry and target zones, scoring the opportunity using odds enhancers, sets determining the stop, entry, target, and position size, and finally, placing the order. We've covered a couple of these components, but we'll dive deeper into each in upcoming lessons. Once you're in the trade, it's important to have a plan to manage the trade, which includes monitoring any reports that are to be released during the life of the trade. And after getting out of the trade, it's imperative to keep a log and a journal of each trade, so you can go back and review your results on a regular basis. Now you know the basics of the trade plan blueprint. Like any blueprint, it's really just a system. System standing for saving yourself stress, time, energy, and money. This blueprint gives you everything you need to develop your trade plan, follow a strong set of rules, and map out your road to success. In this lesson, we'll show you the different types of trading styles and the time frames each uses to help you determine the purpose and duration of your trades and investments. Defining your purpose and duration, otherwise known as your trading style, is the first occasional step. This strategy applies to any market, whether it's stocks, futures, forex, or options, because in any market, it's order flow that drives price. It also applies to any time frame, and therefore can be applied to both short-term income trading and long-term wealth generation. Your trading style will be based on the type of trading or investing that works best for you, either long-term wealth or short-term income, or both. Your trading style will determine the time frames you use as part of your analysis. Let's say on a price chart, it takes 30 candles for price to move to your target. On a daily chart, 30 candles are 6 weeks of trading activity, whereas on a 5-minute chart, 30 candles are 2.5 hours. So if you're investing, you'd use relatively bigger time frames for longer term trades. For short-term trading, getting into and out of the trades quickly, you'll be using smaller time frames. You wouldn't plan day trades on a monthly chart, just as you wouldn't plan investments on a 10-minute chart. Regardless of the trading style, when planning your trades, you will consider more than just a single time frame as part of a multiple time frame analysis. Each time frame is used for a different aspect of analysis. This ensures that you're seeing a complete picture of the overall market conditions. The first is the higher time frame, used to set the curve, which we'll cover in lessons to follow. Secondly, the intermediate time frame, used to check the trend. Thirdly, the lower time frame, used to identify supply and demand zones for entering and exiting trades. Optionally, you can choose to employ a refining time frame, an even lower time frame, to help refine proximal and distal lines for a more specific type of entry. We'll keep things simple with just 3 time frames for now and save that for later lessons. Let's start with short-term income trading. First is hourly income, which is meant for intraday trading, buying and selling within the same trading day. These trades last from minutes to hours. The higher time frame here for the curve is the 60-minute chart. The intermediate time frame used for trend is the 15-minute chart, and the lower time frame where we find our entry and target zones is the 5-minute chart. Daily income trading is also primarily for day trading, with trades lasting anywhere from hours to days. Daily trades for weekly income, if you will. The higher time frame is the daily chart, the intermediate is the 60-minute, and the lower time frame is the 15-minute. Let's switch gears and look at the time frames we use when trading for long-term wealth. We have weekly income trading, which is also known as swing trading. While not considered day trading since trades generally last longer than a day, it's not quite investing either. It's in between. Trades can last from days to weeks, working towards a targeted monthly income. The higher time frame is the weekly chart, and the intermediate time frame is the daily chart. The lower time frame will depend on the asset class. For Forex and futures, a 240-minute chart, that's 4 hours for those of you working through the math in your head, and a 60-minute chart for stocks. Since stocks are open for 6.5 hours a day, dropping from a daily on the intermediate time frame to a 4-hour on the lower time frame doesn't really fit for equities. However, for futures and Forex, where markets are open around the clock, going to a 4-hour as the lower time frame is just fine. Finally, we have monthly trading, which is really more of an investing style. These trades last from weeks to months, with the goal of long-term wealth growth and quarterly or annual income. For this style, the higher time frame is the monthly chart, the intermediate time frame, the weekly chart, and the lower time frame, the daily chart. These inverted triangles visually show you the higher, intermediate, and lower time frames dependent on the type of trading. Here you have another way to look at the different types of income trading and their respective components. It's important you understand that this breakdown of timeframes per trading style is a guideline for you. There's no magical time frame that's going to make you money if and only if you use that one time frame or set of time frames. What you'll notice is that each set of timeframes relates to one another, and that's the key. However, you as the trader have room to adjust to different timeframes as long as the timeframes you're using are relative to one another. Now you know how to define the purpose and duration of your trades by understanding the different trading styles and the timeframes for each. Spend some time to decide which style best suits you. We've all heard the saying, the trend is your friend until the bend at the end. Well, we want to be able to identify the bend at the end to have a better understanding of the market conditions and where price may be headed. In this lesson, we'll take a detailed look at trend reversals. A trend reversal is a pattern of highs and lows that indicates the origin of a trend. Though the term reversal makes you think of the end, and true, it is the first sign of a shift in sentiment, kind of like the writing on the wall per se, it's important you know a trend reversal is actually the beginning of a new trend. So what does a trend reversal look like? The first type of trend reversal is a bullish reversal. It looks like a double bottom or a W due to the shape of its movement on a price chart. An uptrend cannot exist without the shape of a W since it requires a low, a high, another low, and a break of the high. This formation is most likely to occur at higher time frame demand. A bullish reversal indicates the start of an uptrend, and it shows that sentiment has shifted from selling pressure to buying pressure, from supply to demand. You may recall this chart from when we discussed downtrends, but take your attention to the W at the bottom. Remember, a bullish reversal does not automatically terminate a downtrend, but we can see the W is where sentiment shifts and the uptrend begins. We can also see that the downtrend hasn't fully terminated based on its controlling high. Looking left of the W, we notice that in reversing, an opposing supply zone is crossed by price breaking out, again a sign of a shift in sentiment. Price then returns to a drop-based rally demand zone over on the right leg of the W, and this happens often in reversal patterns, and it tends to give us our earliest opportunities to enter a trend. A bullish reversal may take different forms. It could have equal lows, where the lows in the W are the same. It could have a higher low, where the W has a low on the right-hand side that's higher than the low on the left-hand side. Or we sometimes see a lower low, also called a false breakout, where the W has a low on the right-hand side that's slightly lower than the low on the left-hand side. False breakouts tend to lead to the biggest reversals. The second type of trend reversal is a bearish reversal, which is the flip picture of the bullish reversal. So basically, it's an upside down W, or what most remember from their grade school days as an M. The double top of the M shape is most likely to occur at higher time frame supply. A downtrend begins as the shape of an M since it requires a high, a low, another high, and a break of the low. A bearish reversal indicates the start of a downtrend, showing sentiment has shifted from buying pressure to selling pressure, from demand to supply. In the example, our bearish reversal is represented by the M at the top as the origin of the downtrend. Notice the downtrend begins at the bearish reversal prior to the uptrend actually terminating. By spotting the origin of the downtrend even before the previous uptrend terminates, this provides us with an earlier opportunity to enter short into a market that's turning down. A bearish reversal does not automatically terminate the uptrend, but rather begins the downtrend. You'll notice that price finally crosses below the controlling swing low of the uptrend further on the right, but by then we've already had a selling opportunity at a supply zone well before that uptrend was terminated. As with the bullish reversal, a bearish reversal can take different forms. It could have equal highs, where the highs in the M reach nearly the same point. It could have a lower high, which is like a lazy M with a high on the right-hand side that's slightly lower than the high on the left-hand side. Or sometimes a higher high or false breakout occurs, typically into a higher time frame supply zone. Here the M has a high on the right-hand side that pushes higher than the high on the left-hand side. Let's remember that false breakouts tend to lead to the biggest reversals. Every uptrend begins with a W and every downtrend begins with an M, and this pattern tends to form at higher time frame supply and demand zones. Identifying a trend reversal increases the probability that your trade or investment will have significant reward to risk potential because you're catching a trend at its earliest point. The next question we want to unpack is, where is a trend most likely to reverse? We'll get into that next. In this lesson, you have a better understanding of trend reversals, how to identify their formation on a price chart, and what they suggest regarding sentiment. In this lesson, let's add in the final layer of the multiple time frame analysis process, the higher time frame supply and demand curve. While the curve is the last component of multiple time frame analysis that we're introducing, it's actually the first thing that you'll end up checking as you analyze the charts. But we'll get into how it fits into our process a little later. To give a better understanding of what the curve represents, let's start with a question. Would you say that $4 for this mug is expensive or cheap? Well, it's relative, right? It's going to depend on where price has been in the past. In a 52-week range, the price range in this example goes from a lowest point of $3 to a highest price of $14. Considering this range, this gives us perspective to determine that the current price of $4 for this mug is actually relatively cheap. This range is outlined by higher time frame supply and demand zones, which we call curve. Though curve may make you think of something that's bent, trading is actually quite linear. So think of it as a bell curve turned sideways, with the extremes of the curve being the higher time frame supply and demand, creating boundaries for a range of price activity. Curve defines first the higher time frame range of wholesale to retail price levels. Secondly, the intermediate time frame boundaries of expected trend reversals. And thirdly, it defines the maximum profit potential of low time frame opportunities. Let's break that down. On this chart, at the top, you see a higher time frame supply zone, and at the bottom, demand. Think of this as a historical range of movement. So on the low end of this range are historically wholesale price levels, and at the high end of this price range are retail price levels. In between, we can consider prices in equilibrium. Secondly, looking at the same chart, the end zones help determine where the market is most likely to turn. Wouldn't that be nice to know? We see here that the market began an uptrend at the higher time frame demand zone and reversed into a downtrend at the higher time frame supply zone. The most common location for trend reversals is to begin at or near the higher time frame supply and demand zones, and in this way, the curve creates boundaries of the expected reversals of the intermediate time frame trend. Lastly, the curve defines the maximum profit potential for lower time frame opportunities. This really combines the prior two representations of the curve. When looking to make profits in the market, we're looking to buy low and sell high. In other words, we're looking to buy at wholesale prices and sell at retail prices, which are defined by the curve. Well, what's going to carry a trade from wholesale prices up to retail prices, or vice versa, from retail prices down to wholesale prices? The trend. As we learned, our initial profit target will be set at the nearest opposing zone on the lower time frame, but if we're trading with the trend, we can look to ride the trend wave for larger profit potential. But since every trend eventually ends, we can consider a target prior to the expected trend reversal. Well, where do we know the trend ends? at the higher time frame end zones, the curve. In this way, the curve defines for us the maximum profit potential. In this long example, the initial profit potential of this lower time frame demand zone is at lower time frame supply right here. The maximum profit potential is all the way up to the opposing higher time frame end zone, where we could expect the trend to reverse. Now you have an overview of the curve boundaries and what they defined: the range of wholesale to retail price levels, the boundaries of expected trend reversals, and the maximum profit potential. Defining the curve will allow us to see a bigger picture context necessary to assess the probability of our trading opportunities. You just learned the importance of the curve and what it represents. So in this lesson, you'll learn how to set the curve. Setting the curve outlines a range of price, and current price will be somewhere within that range. As such, the curve defines the field of play, if you will, kind of as if we were to draw out the boundaries of a sports field. Within the boundaries of a sports field, the run of play happens, all the action. Similarly, the curve range defined by higher time frame supply and demand is where price is currently moving, and the boundaries of that range indicate where the trend should reverse, which consequently allows us to assess the relative location of where our entries and exits are through this big picture lens. Setting the curve is a simple process. Let's remember that the curve is defined on the higher time frame. So to set the curve, we take the chart to the respective higher time frame, in line with our trading style. Then, step 1 is to identify the nearest quality demand zone. Find the zone, the big move out with a cluster of baby base candles at the origin, draw the zone, and score the zone. While we're not scoring all 6 odds enhancers for these zones, they need to exhibit the characteristics of a quality zone structurally. Step 2 is to find the nearest quality supply zone, finding a strong drop, drawing the zone lines, and assessing the structural quality. Really, you can do steps 1 and 2 in any order. This sections off high on the curve, middle of the curve, and low on the curve. Why do you set the curve? Well, money is made as price moves in the direction of your trade, long or short. To stretch the potential money to be made, ideally, you want to hold trades until and prior to the trend reversal. Since the curve boundaries give context to where you expect the trend to reverse, in this way, the curve provides you with the maximum profit potential for your trades. Now you know the steps to set the curve and the sections it defines. Next, let's look at curve as an odds enhancer. In this lesson, we'll show you how to use curve as an odds enhancer. It's important that you understand that when setting the curve, we're outlining a range, which happens to be defined by supply and demand zones. However, these supply and demand zones are not being used as our entry zones. That's not their role in our analysis. Instead, they're simply defining the current field of play for the product we're looking to trade. When we talk about zone location within the curve, we're referring to where within the curve range that the lower time frame entry zone is located, whether it's in the lower third of the curve, suggesting wholesale prices, in the middle of the curve, suggesting equilibrium, or if it's high on the curve, suggesting retail prices. We ask the question, how high or low does the entry zone sit within the curve? Since we're in the business of buying low and selling high, this is precisely how the curve odds enhancer will be scored. The ideal for a shorting opportunity is to sell high. Therefore, a supply zone located within the upper third high on the curve gets the top score of 1 point. For a long opportunity, we want to buy low. so a demand zone low on the curve also gets a score of 1. If the zone is in the middle third of the curve, whether it's supply or demand, the score gets half a point. And if the zone is in the opposing curve extreme, a supply zone in the lower third or a demand zone in the top third, high on the curve, the zone gets a score of 0. We've said it before, but we'll repeat it again. The lesson here goes back to buying low and selling high. And buying low on the curve and selling high on the curve increase the probability of buying at wholesale prices and selling at retail prices. Going back to our working example, we see the lower time frame demand zone is situated low on the curve. This garners a full point for the curve odds enhancer. Adding this to our scorecard, this zone has a score of 8 out of 10 so far. Notice we only have one more odds enhancer to go. Now you know how to assess and score a supply or demand zone using curve as an odds enhancer. In this lesson, let's look at the 6-step process for setting up a trade in detail. Now that we understand the concepts of curve, trend, and zoning, let's start building a trade using the 6-step process of the trade plan blueprint. Remember, the trade plan blueprint includes both occasional steps and recurrent steps. Over the next several lessons, we'll focus on the recurrent set of steps you take before every trade, the 6-step process. It begins with the pre-steps, followed by step 1, setting the curve, step 2, checking the trend, step 3, identifying zones, step 4, scoring the trade, step 5, sets, determining a stop, entry, target, and position size, and finally, step 6, placing your order. While it's 6 steps, it's really 3 blocks. Find the opportunity, evaluate the opportunity, and trade the opportunity. Using this flow chart as a guide, you can follow the process until arriving at a decision to place the trade or not. You've learned the first 3 steps of setting the curve, checking the trend, and identifying our zones for entry and exit. You'll notice that in the course of this class, you first learned how to identify a zone, then how to check the trend. We spent time finding a zone properly located within the trend, and now, having learned the curve, we're going to combine that into the mix. You've learned things in the order you need to learn them in to properly understand and digest the concepts being taught, but you're going to do things in the order they need to be done. This flowchart outlines the order that things should be done to efficiently and properly identify an opportunity, assess its probability, and place the trade. We'll cover the details of this chart in upcoming lessons, but right now, let's take a quick look at the pre-steps taken before you even begin the 6-step process of setting up a trade. The pre-steps are things you do to begin your trading day. Notice on the flowchart, the pre-steps start off the process. It's important that you understand that prior to starting your technical market analysis as a trader or investor, it's key to go through a short checklist of items to make sure you're focused and ready to tackle anything the trading day may throw your way. We'll go into pre-steps in detail later on, but for now, the checklist items include news, what's happening and what's going to happen, your accounts. We wouldn't want to put a sim trade in the live account now, would we? And finally, you better check yourself before you wreck yourself. In all seriousness, we need to make sure we're in a proper mindset to be planning our trades and investments. In this lesson, we overviewed the 6-step process of setting up a trade and highlighted the pre-steps. As I said earlier, the process to taking a trade is really threefold. Find the opportunity, evaluate it, and trade it. In this lesson, we'll take a closer look at the pre-steps to go through prior to beginning your trading day. These are things you'd do before opening up your charts to find opportunities. Think of it like all the things the team does in the locker room. Final prep before you go out on the field and start trading. Why do you need a pre-trading routine? Well, preparation is essential for a trader's success, and the development of a solid, consistent routine helps you remain patient, focused, and disciplined to make sure your trades are as successful as possible. It also helps ensure that you're looking at the bigger picture, taking in news, events, and announcements, which may be impacting the markets you're trading or investing in. What are the pre-steps? First, let's check our money. Check the account balance to make sure we have sufficient buying power to carry out the trades you'd like to take. Also consider whether you have any open orders in force and what current positions you're in. Second, look for items in the news cycle that might help or hurt you. Economic data, government policy changes, individual company news, or any other headlines that could impact sentiment should be considered. Third, and most importantly, you have to make sure you're mentally in check. This means scheduling enough time to get into a mindset that gives you an edge. Coming up with a routine you can commit to helps you remain disciplined throughout the trading process. We'll get into each component of this checklist in more detail, but now you have a general overview of the pre-market routine. You know, I sing in a band sometimes, and we always rehearse prior to getting on stage. As we were rehearsing the other day and working out the flow and all the kinks, I thought to myself, rehearsal is so important to make sure that we put on a good set and that we don't embarrass ourselves. In the markets, it's the same. Your pre-steps get you prepared and set you up for the day so you're ready to tackle your trading day. When you were younger, you might have been taught to balance your checkbook. Well, unless you're under the age of 30. Nowadays, kids are like, what's a checkbook? I use Venmo. But going back, why were you taught to balance a checkbook? Well, it's twofold. First, you want to make sure you have money in your account if you're writing a check. And second, you want to make sure that the bank didn't make any mistakes recording your transactions. In this lesson, we'll talk about the importance of checking your trading and investment accounts as part of your pre-steps. There are 4 things to check in your account before you set up a trade. The first, and maybe the biggest, is to check if you're in a live or simulated account, known as a sim or demo account. You'll trade in sim mode until you achieve consistent results that would give you a profitable account. Once your numbers prove profitable, then you can consider going live. Always want to make sure you're not sending what should be a sim trade to the live markets. The second thing to check is to check your account balance and buying power. Just like your checkbook, be sure to look at your balances, fees, transactions, and transfers to make sure your account is exactly where it should be. You'll also want to check you have the necessary buying power required by your broker to participate in the trades you're wanting to take. The third thing is to check on your open positions. Depending on your trading style, you may have trades open for days, weeks, or longer. Always be aware of them and how much of the account they're utilizing. Remember, you'll have to allocate part of your account funds to those positions, which may prevent you from entering other trades. The fourth thing to check is for any pending orders you may have set but have not yet executed. Think of an open order as a fish hook in the water. It can be hit at any time. So be sure to stay on top of your open orders and ready to cancel the order if the market conditions change. Check out this account info as an example. First, check your account. As you can see here at the top, this platform is currently in sim trading mode. Second, we look for balances and buying power. As you can see, there are a lot of line items, giving you a clear picture of where your money is currently deployed, as well as what your limits are. Number 3 is to check for open positions. As you can see, we have 2 positions open, one long for 100 shares on SPY and one short for 100 shares on GE. And finally, check pending orders. Some may say filled, meaning those orders have been completed and are done, while others may say working or pending. That means that this is a live order that we should be aware of. It could be filled at any moment, so make sure it is still a trade that you want to be in. Now you know the 4 things you should check in your accounts as part of your pre-market routine. Before you put on any new trades, it's important to take inventory of where you currently stand. Checking your accounts should be at the top of your checklist. Each broker is different on how and where they present the information we talked about in this lesson. Make sure that you know where it is and how to check it. If you can't find something, contact your broker and they'll help you. In this lesson, we'll talk about the importance of checking economic reports. Economic reports tend to happen on a regular basis. Key data about the overall condition of the economy, both locally and globally, can be a great catalyst for market movement. These reports are released quarterly, monthly, and even weekly. Some sites even break down these announcements by how they impact the market, usually high, medium, or low. Economic reports can give us a representation of how the economy or business sector is doing overall. These reports come from various sources. The Federal Open Market Committee releases reports about changes in interest rates and how money coming in and out of the economy is controlled. Other vital reports such as housing starts, the GDP or gross domestic product, and the unemployment rate provide good indications as to whether the economy is expanding or contracting. There are dozens of reports released each week covering nearly every segment of our economy. Why do we use economic reports? Positive news doesn't always mean that price rallies, and negative news doesn't always mean price drops. So we're not trying to predict how the market is going to react. That's what the novice does. Instead, we're aware that news tends to move price in the direction it was already going to move in, just faster. When things don't necessarily go as planned and the consensus from economic analysts is either lower or higher than expected, it can create volatility in the markets. Those spikes and drops in the market can offer us opportunities to buy and sell out of demand and supply zones. Novices tend to trade these reports, especially when there's good news, and tend to buy off the news when possibly they should be considering selling. That gives us an opportunity to take advantage of the 2 key novice mistakes you learned about in earlier lessons. It's important to remember that reactions to most economic news last less than 15 minutes. That's generally when we see the most volatile swings. But that's long enough to provide a great catalyst to get in the market, take some profit if possible, or set up a long-term trade. Where can we go to find economic reports? Most reports, both US and international, can be found on sites such as forexfactory.com. The reports are color-coded, red indicating a high-impact report, and we can read the report and even find out the reactions to check the announcements. You can check economic forecasts from analysts and how they differed from the actual report. Okay, so we have all this economic news and information. Now, what do we do with it? We use it to determine what type of impact it can have on our pending orders and open positions. If you're a long-term wealth trader with pending orders, Refrain from opening a new trade if a high-impact report is scheduled within the next 5 days. Wait for the report to be released because the information may cause an unexpected spike in price, and it also may create a better opportunity in the markets. If you're a short-term trader looking for daily or hourly income, stay out of the markets for 15 to 20 minutes after a high-impact report is made public. Since most people react emotionally to news, wait and give the public time to react. Medium and low-impact reports don't create major swings and have less impact on the market, so most traders simply ignore them. How do we handle news if we have open positions? If you have an open trade that hasn't met your target and a high-impact report is scheduled to hit soon, there are a few things you can do. You could close the trade at a market order before the report is released and avoid the volatility the report may cause. Or you could keep the trade open and tighten the stop loss. That way, in case there's a report that goes against you, your profits are protected up to that point. You could also close just a portion of the position as well, or combine closing some and tightening the stop on the rest. There's options for you. Let's see how economic reports can impact price action on a chart. Price action tends to be flat and sideways before a report is released. In this example, we see price going sideways prior to the release of a U.S. employment report. Markets tend to consolidate within a tight range until the economic report is released because traders are not willing to take a position before the report. But once it's released, markets tend to pick up speed and we may see a big reaction. In this example, after the release of the employment report, there was a strong drop in price out of that consolidated area leading up to the left. Here's another example, a setup of the US Euro dollar on a 5-minute chart. We see the type of market action possible by an announcement from an FOMC meeting, one of the few reports released during market hours. In this case, a surprise in the economic report produced a wild swing in price. If the results had stayed in the range or consensus of the economic forecast, there would not have been as dramatic of action. But if it misses or does better than expected, we see the reaction. We see a drop in price, and if we look to the left, we might find a quality demand zone. If price shot up after the announcement, we would look to the left and consider a supply zone. Of course, all depending on the overall chart context. Now you know the importance of checking economic reports as you begin your trading day. No matter what stock you trade, there are always reports being released which can have a significant impact on share price. In this lesson, we'll talk about company reports. One of the most regular and structured company reports is their earnings. These financial statements are filed quarterly and follow a public schedule of release. These reports are public and available on sites like briefing.com. It's important to pay attention to these reports because the earnings number released usually creates the biggest moves and gaps in the life of a stock. How? It depends on how the company performed compared to the expectations of economic analysts. Analysts issue their own reports forecasting a company's sales, profits, and future plans. If a company's financial statements vary dramatically from what the analysts were expecting, it can trigger a reaction in the company's stock. This can cause prices to rise or drop suddenly. As you can see here, Johnson & Johnson reported earnings on this day, and analysts had expected them to earn $1.44 per share. The actual earnings number was $1.50 per share. That doesn't seem like much, but that was more than 4% higher than analysts had anticipated. This may have caused a jump in the share price that morning. These sharp fluctuations may also cause analysts to issue upgrades or downgrades to stocks, which is the analysts essentially making recommendations to their clients. This information is public though, So we don't want to follow the fold. In fact, we may want to do the opposite of what they're recommending. If we see upgrades suggesting traders to buy, we can check the overall context of these ticker symbols. If the context provides a quality selling opportunity, we can go short against what the novice retail traders will be doing. Similarly, downgrades could provide a sneaky buying opportunity if our chart analysis results in a long trade. In short, if a company is on an upgrade or downgrade list and is being recommended by a popular brokerage firm, we should study the report carefully and look for possible opportunities. For example, you can see at the top that the brokerage firm Deutsche Bank issued an upgrade for the stock SoFun, telling the world that they were raising their forecast for share price from $12.40 to $14.70. Well, Deutsche Bank is a major global firm, which may cause many to buy this particular stock. If that happens, what do you think will happen to price? That's right, it'll probably shoot up. Instead of chasing price up with the other retail buyers, we want to look for strong supply levels where price may turn, giving us a selling opportunity. Company reports can affect price action the same way economic reports can. Earnings tend to cause gaps, as they're usually released before or after the market day. You can see some examples here of reactions. A small gap followed by an average move, a small gap followed by a larger move, or a large gap probably as a result of missing the mark on those earnings. Company reports are a must as part of your checking reports, especially if you're trading stocks. They may move stocks that you have pending orders or open positions on. The key here is to not be caught off guard by any report. In this lesson, let's talk about headline news. Like company news or economic reports, headline news also can serve as a catalyst for movement. Headline news comes in all shapes and sizes, from the small problem like political gridlock to a major incident like a terrorist attack or war. The key with headline news is to keep your emotions in check. You must understand that by the time retail investors get the news, the smart money has already acted on it. It's the nature of the game. So be sure to check on the charts for products you're trading when headline news comes out. For instance, Brexit. Brexit was a major headline news story back in June of 2016. When the United Kingdom voted on whether to remain part of the European Union, many were surprised to learn it had voted to leave. As a result, the euro-US dollar relationship was significantly impacted. The night of the vote, anticipation was high that the UK would remain in the EU, and we saw that price came back into a strong supply area. As the votes came in and pointed more toward a leave vote, price sold off significantly, as seen on this 4-hour chart. If you're not familiar with the way the currency markets move, let me assure you this wasn't a small move. It was gigantic. Because the markets can react to major news events like Brexit, setting up a morning routine that includes studying headlines, economic reports, and company news is important. Your goal is to be aware of any expected news releases, which could impact the markets you're trading. And if something unexpected happens in the world, it often leads to big movement on the charts, which could affect the trades you're in, the orders you have pending, and potentially provide you some opportunity. As you can probably surmise, headline news is a major market mover. Sometimes scheduled and predictable, other times surprising and chaotic. Therefore, it's important to incorporate checking headline news into your daily routine. Having a very consistent and concise checklist of pre-steps that you commit to on a daily basis will help ensure that you're aware of anything that could affect your trades, and you're taking advantage of any opportunities that may arise in the marketplace. Being more strategic than emotional is key to your success as a trader. In this lesson, we'll show you how to get in the right mindset for your trading day. There are 5 mindsets you need to have as a master trader. The first is effective energy management. You want to be in a positive state of mind to feel confident in your ability as a trader and to make sure nothing negative prevents you from believing anything's possible when it comes to placing your trades. My friend Merlin has a great example of this from his trading floor days. He had a long stretch of losing trades and it was dominating his thoughts. He walked into the trading floor one day and his mentor says, "Hi Merlin, how are you doing today?" He glumly responded with, "Can't wait to see how much money I'll lose today." His mentor immediately stopped Merlin and told him that with this mindset, he's already lost. He said, "Go home, regroup, go back through your trading plan, and get back to your rules." 2 days later, when Merlin came back to the trading floor, he ended that losing streak. That was a big moment for Merlin in his early days of trading, and a good example for you that you can't bring that negativity into your trading workspace. The second mindset is maintaining self-awareness and state regulation. You always want to check in with yourself and see how you're doing. If you're not feeling well or not in the right frame of mind, then just pass on trading for the day. Remember, there's nothing that says you have to trade every single day. Be self-aware of your confidence levels to be in the right place mentally to make the best trades possible. There was another young guy on the trading floor with Merlin who was a great trader, but there were days when he lost and his losses were big. After a little digging into why this was happening, he realized that every time he and his girlfriend were in a bad fight, he brought that negativity to the trading floor. He wasn't thinking straight. So when his trading buddies saw him come in with that "I just had a fight" look on his face, they'd encourage him to take the day off. The third mindset is having a skill-building orientation. Keep in mind that you're constantly learning a skill that needs to be developed over time. Don't get down on yourself if you aren't immediately earning huge profits. Nobody starts training for a marathon by running a full 26 miles. They'll start off small at 3 miles, build up to 6, then 10, and so on. You're going to learn to build up your skill set and become more and more consistent over time. A major part of helping in the skill building department is journaling your trades and being honest with yourself when you evaluate your trades. You'll discover areas that need work. Write them down and get the help needed to master areas you're weak on. The fourth mindset is to develop a strategic attitude on outcomes, or as some traders say, an "I don't care" attitude on your trades. It's important to look at each trade as part of a bigger picture. Novice traders take losses emotionally, and that can derail any chance of success. Professional traders understand that even with good risk management and a positive reward to risk ratio, they're still going to have losing trades. So what? As long as those trades do not violate your predefined risk management rules, then shrug off the loss and move on to the next opportunity. Don't trick yourself into believing what we call outcome bias by focusing on every individual trade. And finally, the fifth mindset is to embrace small losses. Losing happens. We're all a bunch of losers. Just kidding. But this is a probability model, and you're going to lose sometimes. What you can't deal with are large losses. So embrace the small losses and avoid the large ones. You don't even need to fret about the small ones because small losing trades are built into your trade plan. By following your rules and being consistent, you will have a higher probability of success. The most important thing to always keep in mind is that you can do it. It will take work, but you can do it. Surround yourself with a community of other traders who share your passion and commitment and continue to develop personally. Commit to becoming a successful trader. As we just talked about, part of your development will be not focusing on the winning outcomes alone. Sure, we all want to win. It's why we're trading. But it's the losses that really matter. Take the time to break down what is causing losses and learn how to fix them. You can program yourself for success with the right combination of strategic thinking and actions. One of the hardest things to do as a novice trader is to leave your emotions at the door. But you have to trust in the step-by-step process. Think strategically, and most importantly, take action. Get in there and put on some trades. Start in a simulated account, and as you become more consistent and build your skills, start to trade live. If you're still uneasy, start with smaller position sizes so you gain confidence. Mentors and community will always help you stay focused and disciplined, so stay connected to a community of like-minded traders. And finally, consistently being prepared. As they say, the only constant is change. Markets are always changing, and you need to be prepared for it. Depending on what you trade, you may need to implement different trading strategies to capitalize on the current market conditions. As a risk manager, you should have a plan for whatever comes your way. Most market professionals will agree that trading is much more psychological than analytical. It's important that you take an honest look into yourself and understand how to deal with certain situations, how you deal with losses, wins. Are you surrounded by naysayers? Are you stubborn? Or are you humble enough to look for help when needed? Are you impatient, unorganized? Wow, I can for sure identify myself in some of those descriptions. The answers to all these questions can give you clues as to how your trading may turn out. So start working today on developing the mindset of a master trader. After all, it's what you aspire to be, right? We're going to begin to build a trade using the 6-step process. In this lesson, we'll begin with step 1, setting the curve. Setting the curve is the first step following your pre-market routine, and it begins our process to identify a trade opportunity. This first step will outline the playing field for the rest of your entire trade setup. The curve range outlines the section of wholesale to retail prices, and it gives context to gauge the likely boundaries of trend reversals. In short, we'll set the curve by finding a higher time frame demand zone and supply zone. Let's look at an example. Make sure that you're on the respective higher time frame, then identify the nearest quality demand zone. It needs to be the first quality demand zone below current price. Next, find the nearest quality supply zone using the zoning process. Though you don't need to have a perfect zone here, it does need to show some quality in its structure for strength time and freshness. Note that the HTF zones are drawn using the wider version, from wick to wick. The higher time frame supply zone represents high on the curve, the higher time frame demand zone represents low on the curve, and everything in between the two zones is considered the middle of the curve. In this lesson, we demonstrated step 1, how to set the curve. Now it's on to step 2. In this lesson, let's continue on in our process to checking the trend. This is the second step in the process to finding an opportunity. Once we've outlined the field of play with the curve end zones, the next question we need to ask is, how is price moving within this curve range? Is it coming up off the curve demand and moving towards the curve supply? In other words, in an uptrend? Or is it coming down off the curve supply and moving towards the other end zone, the curve demand? Another way to consider it is this. Imagine the curve outlines a literal playing field, a football field. The trend tells us which team has the ball. Is it the Bulls? Are they pushing price up? Or do the Bears have the ball? are the sellers in control of the run of the play, pushing price lower. Ultimately, we want to be bandwagoners and go with the team in control. But we also want to be aware of when that team is running out of room on the playing field and where the direction of play is likely to turn around and go in the opposite direction. In trading terms, we're looking to go with the direction of the trend, but with the curve in mind. As price reaches the curve end zones and the trend is possibly overextended, it may change our game plan for the trade. Remember that we go down in time frame from step 1 to check the trend, looking at the direction of price within the curve range. Continuing on with our example, we've moved the chart to the intermediate time frame. Starting with current price and following the candles back, we draw the 3 most recent segments. With the boxes drawn, it's clear that the green boxes are taller than the red box in between. The 3 segments consist of a low, high, a higher low, and a breakout to a higher high. As a result, we're in an uptrend. Pausing to assess the context, we see that within the curve range, price is currently uptrending, and we can see that we still have some room for this trend to continue before it reaches the opposing curve end zone. In other words, it's a good time to go long. In this lesson, we've demonstrated step 2, checking the trend. With that, next step is to find a zone of entry in step 3 to engage this trend. In this lesson, we'll move on in our process to identify zones. Identifying zones is step 3 of the process. Let's recap where we're at here. We started by setting the curve in step 1 on our higher time frame to set the stage for us, outlining the field of play. In step 2, we moved to the intermediate time frame to check the trend to see how price is moving within the curve range. This brings us to step 3, identifying zones. We'll move to the lower time frame to identify an entry zone to go with the trend and an exit zone to gauge our target. For identifying an entry zone, we've moved the chart down to the lower time frame. Remembering we found an uptrend in step 2, we want to look for a demand zone to join that uptrend. We apply the zoning process, and in particular, we want to find the zone within the breakout segment. Narrowing our focus to the green box on the right that's connected to the controlling swing low, we start with current price. Then look down to find a big explosive move up in price with a cluster of base candles at the bottom of the rally. Then draw the zone lines and assess the quality of the zone's strength, time, and freshness. For strength, we see that the leg out moves out at least 2 to 1. And secondly, that the leg out breaks out above a preceding supply zone, in this case, the preceding high. This zone only has 1 basing candle and it's fresh. Once we identify the entry zone, we need to identify the opposing supply zone for our target. After you have both the entry zone and the opposing target zone on your chart, it's time to evaluate the profit zone. We'll introduce profit zone in its entirety in an upcoming lesson. But in short, let's measure the distance between these 2 zones with a ratio. We see we have at least a 5 to 1 ratio, which will ultimately allow for greater profit potential on the trade. In this lesson, we covered step 3, identifying an entry and target zone. This wraps up the technical steps of the 6-step process. Next down the line is to begin to set the trade and place the order. In this lesson, we'll show you how to use the decision matrix. After going through the technical steps of multiple time frame analysis, steps 1 through 3, It's important to pause for a moment to analyze the curve, trend, and zone together to decide whether the big picture perspective of the trade setup is high probability or not. We look at three things: the location of the entry zone within the curve, the direction of the trend, and the type of zone, if it's a supply zone or a demand zone. How these three components combine suggests if and how the trade should be taken. Let's take a look at the decision matrix. On the left is the curve location, high, middle, and low. And on the top is the trend direction, up, down, or sideways. Within the table are all possible crossover combinations. So how do we read this table? First, line up which zone we're trading, supply on the left or demand on the right. Then look at the trend direction you're trading in, up, down, or sideways. This puts you in a specific column. From there, line up in which curve section that the lower time frame zone sits, high, middle, or low. The intersection of the column and row that we land in provides us with a possible action, long, short, or no action. You'll notice that on the supply side, the only action, if any, is short, and on the demand side, the only action, if any, is long, because we wouldn't go long at supply and short at demand. So really what the decision matrix is suggesting is whether or not to take action at the zone given the big picture curve and trend context. Note the advanced label on a few setups. This indicates that the zone is not automatically deemed a no action, but these represent scenarios which are slightly trickier in nature and necessitate certain conditions to make the trade worthwhile. On the outer left and right edges of the decision matrix, you see the setups going with the trend, selling short at supply in a downtrend and buying long at demand in an uptrend. What do you notice about the action when going with the trend? It shows us that regardless of the curve location, probability is high when going with the trend since trends tend to continue. See the advanced label for selling short low on the curve in a downtrend and buying long high on the curve in an uptrend. As price approaches the opposing curve end zone, we're reaching the area where the trend might end, and therefore profits may be limited because there's not much room left on the playing field. But since we still have a confirmed trend to make up for the limited profit potential from the curve range itself, if the opportunity offers at least 5-to-1 profit zone on the lower time frame, then the trade would have sufficient enough reward to risk potential to be worth it. Looking at the countered trend scenario, the columns in the middle for selling short in an uptrend or buying long in a downtrend, the no action in these scenarios is a reflection that you should be looking to go with the trend rather than against it. If you were to consider going against the trend, you'd only do that when you think the trend is going to reverse. Now, where was that? Where did you learn that the trend reversal is likely to occur? Do you remember? Right, at the curve extremes. So this means that where we can consider a short opportunity in an uptrend or a long opportunity in a downtrend is at the extremes of the curve range. Not just within the upper or lower sections, but within the higher timeframe supply or demand zones, respectively. For now, you should focus on going with the trend and leave this scenario to consider once you've mastered trading with the trend. And finally, we have the sideways trend, which provides plenty of opportunity and probability as long as the zone is not in the opposing curve section. Similarly, when the zone is in the middle of the curve, we defer to the trend. In that instance, as long as the zone is not counter the trend, the probability is worthwhile. Let's go back to the trade we've just begun to build. We set the curve, then identified an uptrend, and then found a demand zone on the lower time frame going with that uptrend. it happens that that demand zone is low on the curve. So lining up where this lands in the decision matrix, we're on the demand side in the uptrend column, low on the curve. This is the ideal. And the decision matrix tells us the probability is high with this combination. Now you know how to analyze curve, trend, and zone, that combination, using the decision matrix to help you determine your highest probability, lowest risk, and highest reward trading opportunities. When identifying an entry zone and a target zone on the lower time frame, the last piece of step 3 is to evaluate the profit zone. In this lesson, we're going to talk about what the profit zone is and how to evaluate it as an odds enhancer. Profit zone is simply the distance between the entry zone, where you're looking to open a trade, and the opposing target zone, where you're looking to take your profit. A large profit zone increases the potential reward to risk for the opportunity. And in addition, a large profit zone provides a higher probability that price will turn at the entry zone. In this way, the profit zone is an odds enhancer. Sometimes you may hear profit zone referred to as profit margin or profit potential even. They're one and the same. Let's look at a visual. We have a demand zone as the entry zone with proximal line at 62 and a distal line at 61. This is a unit of 1. The nearest opposing supply zone, the target zone, sits at 67. The distance between these two zones is 5. Putting that into a ratio, we have a 5-to-1. To score the profit zone as part of our odds enhancer scoring, we ask, how far is the opposing zone? If it's far, this increases probability. If it's not far, this takes away from the probability. In the first column, we see that each setup has a profit zone of 5-to-1 or greater. This is the best case scenario as it provides great reward to risk as well as a higher probability of meeting our targets. An opportunity with a profit zone equal to or greater than 5-to-1 gets 2 points. In the second column, each setup has a profit zone of 3-to-1 or greater. While a 3-to-1 profit zone is good, it's somewhat the bare minimum to consider an opportunity. So for opportunities with a profit zone of at least 3-to-1, the score is 1. And finally, in the third column, if a setup has a profit zone of less than 3-to-1, it scores a 0. Let's remember that a large profit zone allows for higher profit potential on the trade. So if an opportunity has a profit zone of less than 3-to-1, our initial target is limited to less than 3-to-1 too. At that point, we'd need to consider if the trade is even worth it or not. The key here is to remember that the larger the profit zone, the greater the probability of reaching your initial target. Looking back at our working example, we have our quality demand zone. Staying on the same time frame, the lower time frame, we identify the nearest opposing supply zone. Notice the profit zone is greater than 5-to-1, which means this zone gets the full 2 points. Adding those 2 points for profit zone to our scorecard brings the total odds enhancers score for this zone to 10 out of 10. Now you've learned all 6 odds enhancers. The odds enhancers can be categorized into zone structure, strength, time, and freshness, context odds enhancers, trend, and curve, and finally, the odds enhancer for reward to risk, the profit zone. The 6 odds enhancers together as a whole indicate the probability of the overall trade setup. In this lesson, you learned what profit zone is, how to assess it, and score it as an odds enhancer to help determine your potential reward to risk for your trades. In this lesson, we're going to briefly overview scoring the trade. Once we've gone through the pre-trading routine, set the curve, checked the trend, and identified the zones, then it's time to score the trade. Essentially, the first 3 steps are to find the opportunity. Then we observe the decision matrix to give us the green light per the trade context, the trend and curve combo. In step 4, you want to look at the overall score of the trade using the odds enhancers. If the score is not high enough or weak, we pass on the trade. If the score is strong, then we can move on to figuring out the entry and exit prices and placing the trade. Once you have all the components of your trade set up, it's important to score the trade using odds enhancers. It's easy to get excited about an opportunity and forget to thoroughly look at the probability of the setup. The markets are constantly moving, and with that, you can get a little jump in adrenaline. You can feel FOMO, fear of missing out on the trade, and therefore rush yourself because you don't want to miss out. I can't tell you how many times I jumped into a trade early on because I was excited and I didn't want to miss the opportunity. And after a stop loss, I'd realize at a second glance that the score actually wasn't that great and the trade shouldn't have been taken in the first place. So never be in a rush. It's okay if you miss the opportunity, another one will come along. Be selective about where you put your money on the line. The odds enhancers help you in that selection process. In this lesson, we previewed step 4. Let's go over a quick review of all the odds enhancers in our next lesson. As we gear up to score the trade, in this lesson, let's review all 6 odds enhancers. Odds enhancer number 1 is strength, which refers to how price leaves the zone, the leg out of the base. Strength reflects imbalance. Remember, there are 2 parts to strength, the move out and the breakout. Move out looks at, did the leg out move out a distance of 2 to 1? Breakout looks at, did the leg out break out past a preceding opposing structure to the left of the zone? For supply, did price break out below previous demand, whether that's a zone or a swing low or some opposing structure? And for a demand zone, did the leg out break out crossing above preceding opposing supply, either a supply zone or a swing high or some opposing structure? If the zone has both a move out of 2 to 1 and a leg out that breaks out, then the zone gets 2 full points. Where only one of these criteria is met, either move out or breakout, then the strength score is cut in half to 1. And if neither condition is met, its strength gets a score of 0. The stronger the move out from a zone, the more out of balance supply and demand are, and the higher the probability the zone will hold. The second odds enhancer is time, which is a reflection of the unfilled orders left behind at the base. We ask, how long did price spend basing at the zone? The less time spent, the higher the probability of many unfilled orders at the base. To measure time, we count the number of basing candles. A zone with 1 to 3 basing candles gets the best score of 1 point. If we have between 4 to 6 candles in the base, then the score for the time is half a point. And for a zone with more than 6 candles in the base, the score for time is 0. Less time at the zone suggests supply and demand are more out of balance at the base, meaning traders had less time to transact, resulting in potentially more unfilled orders left behind at the base. The third odds enhancer is freshness. Freshness is the measure of how far, if at all, that price has retraced back into the base. More unfilled orders reside at a base that has not been touched, and therefore a fresh, untested zone gets the highest score for freshness, a 2. If price tests a zone but reaches into the zone 50% or less, then it scores a 1 for freshness. And if price has retraced to the zone and reached into the zone more than 50% up to the distal line, then it scores a 0. Let me remind you that if price has crossed the distal line of the zone, then the zone is violated and considered disqualified. The fresher the zone, the higher the probability that when price returns to the zone, it will turn around. The fourth odds enhancer is trend. Do we have the right formation in the right location? The highest probability is to go with the trend. Therefore, a demand zone in an uptrend or a supply zone in a downtrend gets the full 2 points. When we have a range, it doesn't get the top score, but we're not going against the trend, so we score a 1. When we're against the trend, either a supply zone in an uptrend or a demand zone in a downtrend, the score is 0, since this results in counter-trend trading. Going with the dominant trend direction increases the probability of price turning at the zone and gives us the best opportunities for successful trades and greater profits. The fifth odds enhancer is curve, which helps us determine how high or low the entry zone is located within the curve range. When selling, the best case scenario is for the lower time frame supply zone to be high on the curve. And when buying, the best case scenario is for the lower time frame demand zone to be low on the curve. In these cases, the zone gets the best score for curve, a 1. When a zone is in the middle of the curve, regardless if it's supply or demand, it gets half a point. And lastly, when the zone is in the opposing curve section, either a demand zone high on the curve or a supply zone low on the curve, it's considered an unfavorable location within the curve and gets a score of 0. The bottom line is, we want to be buying low at wholesale prices and selling high at retail prices. The sixth and final odds enhancer is our reward to risk odds enhancer, profit zone. How far is the opposing fresh zone? When we're assessing a trade opportunity, we want to see that we have a clear path to profits. That's what the profit zone evaluates for us. The best scenario for a zone is a 5-to-1 or greater profit zone, which scores a 2. If the opportunity has a profit zone between 3-to-1 and 5-to-1, the zone scores a 1 for profit zone. And finally, when price only has the potential to move less than 3-to-1, we really have to consider if the reward potential for the trade is worthwhile. Setups with a profit zone of less than 3-to-1 score a 0. Remember, the larger the profit zone, the greater the probability of reaching your initial target. Odds enhancers are categorized into zone structure, context, and reward to risk. Strength, time, and freshness represent zone structure. For context, we look at trend and curve. And lastly, the profit zone represents reward to risk. The total score of all 6 odds enhancers indicates the probability of the trade setup. The higher the total score, the higher the probability of a successful trade. Your total score also suggests the type of trade entry to take when price comes back to the zone. Why is that? Well, if we have a high score, this means probability is highest. If it's a probable opportunity, then we don't want to miss it. So for a zone that scores an 8.5 or greater, we can consider a proximal limit entry, which gives us the best chance at getting filled. For a zone with a medium score between 7 and 8, then it scores high enough to be considered, but the probability is not as high. So we can wait for price to show a sign it's reversing at the zone before looking to enter using a confirmation entry. And if we have a lower score, less than 7 points, this indicates a lower probability, and we may consider not taking the trade in this case. So the odds enhancer score measures the probability of a trade and consequently provides us with a possible entry type. Note that the entry type, position size, and risk may vary depending on an individual's trade plan. For example, you may decide for yourself that you only want to take proximal entries and you're willing to accept a 7 or greater. That's up to you to decide for yourself. Now you've seen the full odds enhancers pie. We want to measure all 6 for each setup that we trade to increase our odds of success. In this lesson, we're going to look at position sizing and the 2% rule. We know where we're going to enter and exit, that's set, stop, entry, and target. And now we want to look at how much we're going to buy or sell, the position size. The position size is the number of shares, contracts, or lots necessary to buy or borrow and sell short to achieve pre-planned risk and reward in a trade or investment. When position sizing, there are 3 main components. First, you got to figure out how much money that you're willing to lose on any given trade, which is the account risk, calculated as a percentage of your total account size. Secondly, you measure the trade risk for a specific trade, which is the distance between the entry and the stop. And finally, the third factor to consider is the cost to enter the trade, which is the amount of money deposited from your account to take the position. The cost will differ if you have a cash or a margin account and how much leverage is given. We're going to look at each of these components and how to calculate out the position size in an upcoming lesson, but let's talk further about account risk. Now, each asset class will have a specific way to calculate the position size, since the price per share, contract, or lot differs based on the asset class. And the price per product can differ even within an asset class. For example, gold is $100 a point, while natural gas is $10,000 a point. You can learn about these nuances within the asset class specific courses. Regardless of the asset class you're trading, you'll decide on the amount you're willing to lose per trade as a percentage of your account. You can use the 2% rule as a general rule for determining the account risk, which is a rule that applies to all asset classes. Just keep in mind, you'll need to choose the appropriate amount of risk you're willing to take as a part of your trade plan. Risk is going to be related to your account size. A person with a $10,000 account will have a different risk limitation than a person with a $500,000 account. What the 2% rule says is to limit your risk to no more than 2% of your account size on any one trade. Of course, you'll decide your risk amount for yourself, but the intention of this rule is to make sure that you're not losing too much of your account on any one single trade. Risking less than 2%, say 1% or 0.5%, is absolutely okay, but the rule simply says to not exceed 2% of the account size. Now, when you're holding positions overnight, even if you've placed a stop loss order for the trade, stop losses don't work when the market is closed. This means when carrying a position overnight, due to the potential for overnight gaps, your risk on the trade could increase significantly if price gaps. So you, as the trader, need to consider if it's worth it to you or not to hold a position overnight. Equities are impacted more by overnight gaps than other asset classes, since they're only open 6.5 hours a day and have the potential to gap each day. By using a percentage of the account to determine the account risk, as the account grows, so will the percentage. This makes sense. If the account is growing, then you've reached consistency. If you're making money consistently, it may be a good idea to bump up your position size so that you can see more growth of your account. Let's pause here to talk about this particular point. We all know Derek Jeter, right? Baseball player for the Yankees, who's one of the most consistent batters at about .310 career batting average. For those who aren't familiar with baseball, this means he's successful at bat at a little more than 30% of the time. And guess what? He's been inducted into the Hall of Fame with that win rate. And you can be too in your trading and investing if you manage your risk properly. In any case, let me ask you a question. Could Derek Jeter double the number of runs he bats in by, say, using 2 bats at the plate, or triple it using 3 bats at the plate? Well, of course not, but it is a fun visual to think of him swinging that many bats. But for us, we can. What Derek Jeter has reached is a level of consistency, which is what makes him such a successful player. But he's limited to 1 bat. If you can reach a high level of consistency, you can increase your payout by increasing your position size. But before you get ahead of yourself, just remember that when increasing your position size, you're both increasing the potential profits and the potential loss. So the point we're making here is that consistency is key. Focus on consistency, and increasing your potential profits on the trade is the easy part. Now you have a better understanding of position sizing and the 2% rule. Remember that regardless of the percentage used, you as the trader or investor need to determine the maximum risk on your trades and investments per your account size and your personal risk tolerance. In this lesson, we'll show you how to calculate position size. As you see at the top, position size is determined by dividing the account risk by the trade risk. Our strategy teaches 3 steps to help you calculate your maximum position size. Step 1 is to establish a maximum account risk for each trade based on a percentage of the account size, not exceeding that 2% rule. The number you decide needs to be something that you're okay with losing, that you'll be able to go to sleep at night knowing this is your max risk. Step 2 is to calculate the individual trade risk, or the distance from your entry to your stop. And finally, step 3 is to divide the maximum account risk from step 1 by the individual trade risk from step 2. Let's look at an example. For step 1, establishing the maximum risk amount, if you have an account size of $30,000 and you were to utilize the 2% rule, then the maximum risk amount on any trade is no more than $600. For step 2, calculating the individual trade risk, you measure the distance from the entry to the stop. In the example, the entry is at $22.30 and the stop at $21.90. Calculating the difference, we have an individual trade risk of 40 cents. In step 3, to figure out the number of shares, we take the total account risk per trade of $600 and divide it by the individual trade risk of 40 cents, which gives us a maximum position size of 1,500 shares. You may need to adjust your position size depending on different conditions that could come about. For example, you don't want to exceed 50% of your total account capital on one trade, meaning that if you have an account size of $30,000, you don't want to tie up the entire amount, or worse, exceed that amount on any one trade. This allows you to enter more than one position at the same time because you're not tying up the total account capital. These rules may vary depending on your risk tolerance. For example, if our maximum position size is 1,500 shares, and we multiply that by our entry price of $22.30, then the cost is $33,450, the amount of money that the broker requires to hold in the account while in the trade. To not exceed 50% of the total account size of $30,000, we can adjust the position size based on 50% of the total account, or $15,000. We do this by taking that $15,000 and dividing it by our entry price of $22.30. So with 672 shares, we won't exceed 50% of the account buying power. This isn't necessarily a bad thing, because when we go back and calculate the adjusted risk for the trade, we find that we are well within our max allowable risk per trade of $600. By multiplying the new position size of 672 shares by the risk per share 40 cents, the risk on this trade is $268.80. Dividing that by the account size, 30,000, we see we're only risking 0.89% on this trade, well below the 2% maximum. How does adjusting risk affect the reward? Looking at an example with a $30,000 account, targeting 3-to-1 reward to risk, at 2%, the maximum risk would be $600. 3-to-1 with $600 means the reward would be $1,800 or greater. If we choose 1% risk, then our risk drops down to $300. So for every $300 we're willing to lose, we need to be able to make at least $900 in profit. And finally, with risking 0.5%, then our risk drops down to $150 and the respective reward to $450 or more. In summary, step 1 is to establish the maximum risk amount based on a certain percentage of your account size, not to exceed 2%. But again, this should be based on your personal comfort level. Step 2 is to calculate the individual stop size on the trade by taking the difference between the entry price and the stop loss price. And finally, step 3 is to calculate the position size by dividing the maximum risk amount by the individual trade risk, and if necessary, adjusting that number down based upon your need. As you see, it's also important that every time you put on a trade, you're accounting for the proper position size. Doing so will ensure that you're not taking on too much risk on your trades. Now you should have a good idea of how important position sizing is to your success in the financial markets. In this lesson, we'll look at the differences between cash accounts and margin accounts. We'll also explain how margin is used for leverage. In a cash account, a trader or investor pays the full cost for a position with cash. So if a position costs $5,000, you would have to have $5,000 in your account to pay for the position. In a margin account, however, an investor or a trader borrows money from a broker to pay for a portion of the cost of their position. The amount of leverage varies depending on asset class, type of trading you're doing, and how long you hold the position. Margin is essentially the amount of collateral the broker is requiring from the trader to invest in order to open a position. While leverage is the result of using margin, it's basically a multiplier by which a broker will lend capital to a client in order to fund a position. Margin requirements can also vary from firm to firm, so you should always check with your broker ahead of time. As an example, say we decide to buy 1,500 shares at $22.30 per share. This requires $33,450 in buying power. Margin allows us to buy the same number of shares using less capital. In the stock market, you are usually offered a 2-to-1 leverage for overnight trading with a margin account. So instead of having to come up with the full $33,450, we're only required to have half of that in the account, or $16,725. If you're considered a pattern day trader and close out of your trades by the end of the trading day, you may get up to 4-to-1 leverage. This means that the required capital in the account is only 1/4 of the original cost, or $8,362.50. However, if we have a 4-to-1 leverage during the day and we want to hold the margin overnight, then it reverts to the 2-to-1 leverage, meaning we're responsible for coming up with the additional $8,362.50. Now you understand the difference between cash and margin accounts, and you know how to use margin for leverage. It's important to know ahead of time what type of account you're planning to trade from so that if you choose to take on margin for leverage purposes, you have a clear understanding of your broker's rules and requirements for what it takes to manage your account for entry, whether it be a cash or margin. In this lesson, we'll show you how to set up a trade using sets: stop, entry, target, and position size. This is step 5 in the process for every trade. After setting the curve, checking the trend, and identifying zones, the technical steps of the process, if the decision matrix and odds enhancers scored tell us the trade is viable, then we're ready to move forward. So we set up the trade by figuring the stop, entry, target, and position size. In the example, we're looking to buy at the demand zone, anticipating that price will turn at the zone. But in case we're wrong, we have a protective stop based on the stop buffer to get us out of the trade for a small loss. We find the first opposing supply zone as a target zone and place the target just below the zone to lock in profit for a reward to risk ratio of at least 3-to-1. We have an entry price of $44.50. The distal line is $44.25 and the stop buffer is 15 cents. So the adjusted stop is $44.10, which is a risk of 40 cents per share. We look above to find the nearest opposing supply zone, the target zone, and place the target just below at $45.70, giving us at least a 3-to-1 reward to risk ratio. Based on the account size, it's decided we can lose up to $150 per trade. Remember, when position sizing, we take into account our individual account risk, the trade risk from entry to stop, and the cost of the position. With those 3 factors in mind, we calculate a position size of 337 shares. If we go long at $44.50 and get stopped out at $44.10, then the risk for this trade with 337 shares is only $134.80. We see that the trade will cost only $14,996.50, which is about half of the $30,000 account size. Since this is a long-term income trade, the stop buffer is 10% of the daily average true range. Because daily ATR is 150, that's why the stop buffer is 15 cents. What's the cost impact to put on this trade? It depends on whether we're using a cash account or a margin account. If we're using a cash account, we would need to hold the full $14,996.50 in our account. But if we have permission to use a margin account with day trading, we have leverage up to 4-to-1, which means we only need 1/4 of the total cost to put this trade on. Calculating 1/4 of $14,996.50, we're only responsible for $3,749.13. Keep in mind that pattern day trading rules apply, and not all accounts offer 4-to-1 leverage. Consult with your broker to understand their margin requirements. When holding a trade overnight, the standard with a margin account is 2-to-1 overnight. This requires you to have $7,498.25 of that $14,996.50. In other words, 1/2 of the capital required in your account to hold it overnight. Now you know how to set up a trade using sets: stop, entry, target, and position size, which is step 5 in the 6-step process of your trade plan blueprint. In this lesson, we'll review how to place the order, the last step to take the trade. At this point in the trade, we've already set the curve, checked the trend, and identified zones within the proper context of the big picture. Then the decision matrix and odds enhancer score gave us the green light, and so we decided the sets for the trade. Now we're ready for step 6, placing the order. Before we place the order, we must set the duration of time we want the order to remain active. This is called time in force or duration. We will look at the two most common ways we can place the order: day only or good to cancel. Day only means the trade will only be in force for one trading day. That means if it isn't filled by the end of the trading day, then the order is canceled automatically. A good to cancel or GTC order remains active for as long as you decide on or your broker decides based on their policies. It's important to check with your broker first, since there may be other ways to place the order. GTC orders are the safest choice for brackets, as you may hold your trades for longer than one day. Let's start placing the order. As you see in this example, we want to enter at the proximal line of the demand zone at 44.50, with a stop loss below the zone at 44.10, and a target below the first opposing supply zone set at 45.70. Below the price chart is a bracket order to set this up on ticker symbol FXI. We can have 337 shares. The top line represents the entry order, a buy limit order at 44.50. Because we're not there yet, we choose a GTC or good to cancel duration so that the order remains active until price gets to 44.50, or we choose to cancel it ourselves. The next two lines are the bracket, the stop, and the target. Through OSO, order sends order, once the entry order fills, it simultaneously sends the other two orders to the market. The stop and the target orders are linked. They're set up as an OCO, order cancels order. If one order is executed, the other is canceled. So the next row has the target with a sell limit order at 45.70. The last row is for the stop, a stop market order. If price gets to the stop price of 44.10, it sends a sell market order. Now you know how to place an order. It's important to always check and confirm you have the right stop, entry, target, and position size. Once you got all that, all that's left is to send it. In this lesson, we'll review the trade plan blueprint's 6-step process to take before every trade. Though it's 6 steps, it's really 3 blocks. Find the opportunity, evaluate the opportunity, and trade the opportunity. This process is designed to help you find and trade the highest probability, lowest risk, and highest reward opportunities. For finding the opportunity, we have 3 steps in which you'll be applying 2 skills, either drawing a zone or identifying the trend, and you'll do them 1 step at a time. Step 1 is to set the curve. To do this, we find the nearest quality demand zone, and next, we identify the nearest quality supply zone. By using the zoning process, we're checking the strength, time, and freshness of these zones. They don't need to be perfect, but they should exhibit some quality. This creates areas that are high on the curve, retail prices, in the middle of the curve or equilibrium, and low on the curve, wholesale prices. Step 2 is to check the trend on our intermediate time frame. This measures price momentum between the high time frame curve boundaries. We start with current price and draw the 3 most recent segments. We evaluate the trend and confirm that the trend is valid. In this case, with higher highs and higher lows, we have an uptrend. Step 3 is to identify entry and target zones on the lower time frame. In this example, since we identified an uptrend, we're looking for a demand zone in the breakout segment of the uptrend. Following the arrow down and left, there's the entry zone. Next, we identify the nearest opposing supply zone for our target. Then, we want to measure the distance between the LTF zones to check the profit zone. The ideal here is 5-to-1 or greater, with the minimum being 3-to-1. Steps 1 through 3 are the technical steps, and once completed, we want to use the decision matrix to analyze the combination of curve location and trend direction of the zone. In this example, the zone is low on the curve, we are in an uptrend, and we're looking to buy at demand in the breakout segment of that uptrend. We see that we have the green light to go long. After the decision matrix, we move on to step 4, scoring the trade, using the 6 odds enhancers. For strength, we see the breakout occurred, the leg out took out previous supply, and it rallied to at least 2-to-1, so it gets a 2 for strength. For time, there's 1 candle in the base, so we give it the top score of 1. For freshness, we see that price hasn't returned to the zone since it was formed, so it gets the full 2 points. A demand zone in an uptrend gets 2 in the trend category. Since it's low on the curve, the zone gets 1 point for curve. And because there's a profit zone greater than 5-to-1, we add another 2 points. The total score for all odds enhancers is 10 out of 10, which allows us a proximal entry. So for step 5, sets. With a proximal entry, we can enter with a buy limit order at 44.50. For the stop loss, we take the stop buffer into consideration. If short-term income trading, we use 2% of the daily average true range. And if long-term income trading, we use 10% of the daily average true range. Once calculated, we place our stop below the distal line of the demand zone by at least the amount of the stop buffer. In this example, 44.10. For the target, we place it just before the opposing target zone, making sure it provides our minimum reward to risk ratio, in this case, 3-to-1. What's left is to calculate the position size. Take the account risk, or the max loss you're willing to take on any trade, and divide it by the individual trade risk, the difference between the entry and the stop. With an account risk of 150 in this example, and a stop size of 40 cents, 44.50 minus 44.10, we see that the maximum share size is 375 shares. Keep in mind, if the amount is too much when it comes to buying power, or you don't want to tie up as much money, you can always reduce the position size. For example, if we multiply the 375 shares by the entry price of 44.50, the total cost comes out to $16,687.50, over half of a 30,000 account size. To not exceed 50% of the total account capital on one trade, we can adjust to tie up only 50% of total account size, or 15,000. To figure that number, we divide 15,000 by the entry price, 44.50, and adjust the position size to 337 shares. With this, if we get stopped out, the modified risk is $134.80. Our sixth and final step is to place the order. We'll use a bracket order to buy 337 shares with a limit order at 44.50. We'll set the duration on this trade as GTC, good to cancel, to keep this order open until price reaches 44.50. How OSO works: once filled, the system will automatically send the other two orders, a sell limit at 45.70 for the target order, and a sell stop market order at 44.10 for the stop loss order. If the target gets filled, then the stop will cancel. If the stop gets filled, then the target will cancel. That's how OCO works. And that's the full process. While the idea of 6 steps can be overwhelming, you really only have 3 technical steps in which you'll be doing something on the charts. Within those steps, you're only using 2 skills, either zones or trend. So just take it one step at a time. In this lesson, we'll show you how to create a watch list for income trading opportunities and explain the criteria it should include. Creating a watch list is part of the occasional steps taken as part of your trade plan blueprint. In short, a watch list is a list of symbols that a trader or investor scans through each time they begin their chart analysis. By regularly monitoring the same markets, you'll begin to get a feel for their personalities and nuances. Because while supply and demand applies to any market, each market has its own rhythm. For example, crude oil is a mover. Generally speaking, it has higher volatility than, say, the bonds markets, which don't tend to move with as much speed. Both are governed by market trends and supply and demand, but their cadence is slightly different. That's something you notice as you get to know these markets by analyzing their movement consistently. So the question is, which markets should be included in your watch list of symbols that you trade on a regular basis? The symbols in our watch list should match what we trade or invest in with our purpose. By creating a watch list, it can reduce the time it takes to find trading opportunities. Now, each asset class has its own criteria and selection process for building a watch list, which will be covered in their respective courses. But the key components to a viable security are enough participation, determined by volume and liquidity, and movement, tracked by average true range and beta. Let's talk about creating a watch list of equities for income opportunities, a crucial part of developing a trading plan. There are thousands of stocks and ETFs out there, and having to sift through all of them would be a daunting and near impossible task. So in sort of a good way, not all are suitable for short-term income trading, which narrows the list of what to focus on, keeping things simple. The first component of the income watch list criteria is liquidity. Assets with enough liquidity increase the chances of getting our orders filled, keeping our spreads small, and offering trades with the least possible amount of slippage. To assess the liquidity of an asset, we use volume and spread. The second component is volatility. We want markets that move, because an asset with good volatility increases the number of potential opportunities. To assess volatility, we use average true range. Let's talk a little more about volume, or how many shares have exchanged hands when orders were filled. Volume is a representation of liquidity since it adds up the total number of shares, contracts, or lots that were traded during a given period. A market with high volume indicates plenty of participation, providing high liquidity. When a market's volume is low, this represents less participation or low liquidity. To measure volatility, we use average true range. Average true range, or ATR, is an indicator that reflects the average range price moves over a given period of time, typically 14 candles. As you can see from the chart, the ATR fluctuates over time. Comparing the price movement with the ATR, you'll notice that the ATR decreases during phases of lower volatility, where the candles are narrower in range and moving in a sideways, choppy fashion. And when the movement of the candles becomes more volatile and the candles expand in range, the ATR increases. With that in mind, here are some basic criteria for short-term trading on an hourly basis with equities. The price of the security is the first criteria. The price should be high enough that we can trust there to be institutional involvement in the security, but not so high that opening a position ties up too much buying power. We can look at securities between $15 and $250. Depending on your account size, you may extend that price range above $250 or narrow it below $250. Secondly, we can look for equities with an average daily volume of 1 million shares or more. Lastly, a daily ATR of at least $1. Most platforms come with a scanner of some sort. There are several online resources as well to help you search for and filter opportunities based on your watchlist criteria. Finviz.com, while no affiliation with us, is great for filtering through the universe of stocks and finding what you're looking for. Now you know what a watchlist is and the criteria you use to create one for short-term income trading. Scanning for opportunities saves you time, and most importantly, it aligns what you're trading with why you're trading, your purpose. In this lesson, let's talk about setting risk and reward rules. Setting risk rules entails deciding how much money you're willing to lose on a trade. As your account changes, so will the amount you're willing to risk. Now, that's not going to change day to day, but you'll revisit this monthly, quarterly, or maybe annually as one of your occasional steps. One of the main reasons a trading plan is so important is that it establishes a set of rules and criteria to follow. Trust me, the markets are tempting. In my early days of trading, I'd hit a winning streak of a whole 2 winners in a row and think, hey, let's double up on the position size and make double the money. Of course, with that comes the possibility of losing double as well, but I was blinded by the dollar signs in my eyes. And as Murphy's Law would have it, I'd lose that trade and give back a big chunk of my earnings from the prior 2 trades. This is not the formula for success. Instead, it's key to be consistent with your risk rules in order to keep our losses small and our winners big. So don't be like me when I first started out. Establish rules for risk and reward, and more importantly, follow those rules. Once you define your trading style and the timeframes you'll be using in your analysis, you're ready to establish your risk and reward rules to determine how much money you're willing to lose on any trade and how much money you're targeting to profit on any trade. The first rule is the 2% rule. Stay within 2% of your account size for capital risk on any single trade. Secondly, when trading multiple positions simultaneously, consider not exceeding 6% of your total account across all open positions. Both of these rules protect the account from large drawdowns that become difficult to sustain. You'll decide your risk rules for yourself, but you don't want to risk anything more than you feel comfortable losing. Every trade has risk, and we have to be okay with the idea that not every trade will go in our direction, and we will lose money as part of the cost of doing business. As long as we manage our risk properly, we'll avoid exposing the account to big losses that the account won't be able to handle. The third rule is on the reward side. The formula for success is to keep losses small and our winners big by aiming for high reward to risk potential, a good benchmark being 3-to-1. By aiming for a 3-to-1 reward to risk ratio on the trade, we're taking the pressure off of ourselves to be right all the time. We can lose 3 times, and 1 winner compensates for those losses and brings the account to break even. When aiming for 3-to-1 on the trade, we want the chart to offer us more than that in profit margin. This increases the chances of hitting the 3-to-1 target. So we'll focus on opportunities with at least a 5-to-1 profit zone, providing an easier path to achieving 3-to-1 or greater on the trade. The fourth and final consideration is regarding target placement and multiple targets. Our initial profit potential, where the target 1 would be placed, is based on the nearest qualified opposing zone on the lower time frame. Since joining a market trend has a good chance of carrying the trade to greater profits, we want to ride that out for more money. When shooting for a greater move on the trade, we can gauge our maximum profit potential on the curve and place target 2 based on the opposing curve end zone. Now, a complete order to be sent to the exchange includes stop, entry, target, and position size, otherwise known as sets. Once we determine our risk rules, how much money we're willing to lose on a trade, and our reward goals, how much money we're looking to target for potential profits on a trade, we can now place our stop, entry, target, and position size accordingly for any trade opportunity we identify. Once a high probability opportunity is identified, we'll further refine risk and reward based on the rules and considerations we just covered through the following 4 components: stop buffer, where to place the stop; entry types, how to enter the trade based on its probability; target buffer, where to place the target; and position size, the quantity you should look to trade. In this lesson, you learned the rules and considerations for risk and reward. Next, we'll look at each component of sets. We've talked about how the stop goes beyond the distal line of the zone, but the question is, how far? In this lesson, we'll introduce the stop buffer to help define where to properly place the stop loss order. First, let's go back to why your stop loss order should be placed beyond the distal line. Remember that in order for price to turn at a quality zone, there must be enough unfilled orders at the zone. If you place a stop loss at the distal line of a quality zone, where unfilled orders may live, then there's a chance price could move to the distal line of the zone, stop you out, and then proceed to reverse at a valid price, which is probably one of the most frustrating things that can happen to you, to get stopped out only for price to move in your direction. For this reason, we put the stop loss order beyond the distal line. We've answered the question of why. Now let's look at where. The stop buffer is the distance beyond the distal line where the stop order is placed. To calculate the stop buffer, we use a percentage of the daily ATR, or average true range. Depending on your trading style, you'll use a different percentage of the daily ATR. If you're trading for short-term, either hourly or daily income, you can use a stop buffer of at least 2% of the daily ATR rounded up. If you're trading for long-term or swing trading, either weekly or monthly income, you can use a minimum of 10% of the daily ATR rounded up. At a supply zone, we add the stop buffer amount to the distal line, and at a demand zone, we subtract the stop buffer amount from the distal line. It's important to note that these are the minimum values. You can choose to adjust if needed. Let's look at a couple of examples of how to calculate the stop. Say we have an income trade on QIHU on a 5-minute chart to go short at supply. First, we look to see that QIHU has a daily ATR of $3.13. To calculate the stop buffer for income trades, we use 2% of the daily ATR. Multiply the daily ATR of $3.13 by 2% to get 0.0626, which we round up to 7 cents. Because we're at a supply zone, we add 7 cents to the distal line for the stop loss price. Let's look at a longer term trade. The process is the same, but the percentage is different. In this example of CINA on a 240-minute chart, we see from the table on the right that the daily ATR is $3.44. For wealth trades, we use 10% of the daily ATR. So multiply $3.44 by 10% to get 0.344, which we round up to 35 cents. Now we place the stop 35 cents above the distal line of the supply zone. Now you know how to calculate the stop buffer and apply it to the stop loss price to refine your risk. We don't need to give the trade too much room to breathe, which allows us to keep our risk low. But we do need a stop buffer to give us a little wiggle room as a cushion between the distal line of the zone and the stop loss price. In this lesson, we'll review the 3 entry types and discuss the advantages and disadvantages of each. We have 3 basic entry types for going long at demand or short at supply: the proximal entry, the zone entry, and the confirmation entry. The type of entry you use is determined by scoring the trade using odds enhancers in step 4. Let's review. The line of price you see represents price returning to the supply or demand zone. The first entry type is the proximal entry, also referred to as a limit entry since it uses a limit order. This entry gets you into a trade at the proximal line price as price comes back to test the zone. Of the entry types, it gets you into the trade soonest. The second type is the zone entry. A zone entry can use either a limit order or a market order to enter a trade at not the proximal line price, but instead at a price a little deeper into the zone. The third type of entry is a confirmation entry. A confirmation entry waits for price to come back into the zone, reverse, in a sense, confirming its switching directions, and then leave the zone before the trade is entered. A stop order can be used to achieve a confirmation entry. Now, each entry type has its advantages and disadvantages. Proximal entries have the highest probability of meeting entry. You'll notice that a proximal entry is recommended for the highest scoring zones because if the zone scores high, it's very probable. And if it's very probable, then we don't want to miss it. So we use a proximal entry. They're also good for traders who prefer a set it and forget it style. Set the trade and then go golfing or shopping or whatever it is that you wish to do other than stare at your computer screen. On the other hand, a proximal entry has a lower reward to risk ratio than a zone entry because you're buying higher if it's demand or selling lower if it's supply than you would with a zone entry. This means you're widening the risk and narrowing the reward as compared to a zone entry. And lastly, the chance of getting stopped out is higher than, in particular, the confirmation entry. Now a zone entry. As we just mentioned, it carries the lowest risk and highest reward of all 3 entries since we're buying lower than the proximal line of the demand zone or selling higher than the proximal line of supply. And that's really why we'd employ a zone entry, is to get a better reward to risk ratio out of the trade. While it has a better chance of meeting entry than the confirmation entry, it has less of a chance of meeting entry than the proximal entry. That's the disadvantage here. If price comes back to the zone and only tags the proximal line, then you'd be filled if you use a proximal entry, but you wouldn't be filled using a zone or confirmation entry. Also, generally speaking, there's not an easy way to automate a zone entry on most platforms, which can somewhat limit your flexibility. For a confirmation entry, the risk and reward are nearly the same as a proximal entry. Only this time we're waiting for a confirmation of price reversing at the zone. Note that when a zone scores so-so with the odds enhancers, it shows a confirmation entry. The entry type comes down to confidence. If we're confident in the zone, we don't want to miss it, so we use a proximal entry. If it scores enough to be considered, but is missing a few elements that would increase the probability and bump up the score, then we're not as confident. Consequently, we'll watch to see when price returns to the zone that it confirms a shift in sentiment and a turn in direction at the zone before entry. In this way, there's less of a chance of being stopped out of the trade when using a confirmation. So think about it. If price comes back to the zone and rips right through it, you'd have been filled and stopped out with a proximal entry and possibly with a zone entry as well. But since price never confirmed the reversal, we would not have been filled and stopped out with a confirmation entry. Now, it's important you know that the chances of getting stopped out are reduced with a confirmation entry, but not entirely eliminated. The disadvantages? Of all the entries, a confirmation entry has the lowest probability of meeting entry, and this is the most complex order to set up and submit in a trading platform. Now you know the 3 types of entries used for trading: the proximal, zone, and confirmation entry, along with the advantages and disadvantages of each. Using the right entry type based on a trade score provides the highest probability of a low-risk, high-reward trade. In this lesson, we'll review reward to risk ratios and explain their importance to your overall risk management. For anyone looking to trade or invest their money in the financial markets, they have 2 main considerations. First, what is the likelihood of price moving in the direction of their trade? And secondly, is the payout worth the risk? My favorite part of this strategy is that when you buy long in a demand zone and sell short in a supply zone, these 2 components of probability and profitability go hand in hand. Let's explain further. When you look to buy at demand or sell at supply, you are doing so for 3 reasons. First is to minimize risk. Take a look at this example. The risk on the trade is essentially limited to that little base or demand zone. This provides you with a defined minimal amount for the trade. So if the risk is too great, you pass on the trade. In this example, it's $1 risk per share. Is that too much for you? You can accommodate your trade risk by adjusting the number of shares you're trading, or pass on the trade altogether. This brings us to our second point: maximize probability. That means you decide which trades to take. Ideally, they are taken when there is great profit potential. For us, the profit potential is measured by the profit zone. But I want you to think about something. If all the profit zone did was ensure the trade provides a great reward to risk ratio, then it wouldn't be included as an odds enhancer. It would just be a checklist item before you place the trade. But the profit zone is an odds enhancer. Having a big distance between the entry zone and the nearest target zone can create a vacuum of space. This plays into the imbalance between supply and demand at the base, and where there's a big imbalance between buyers and sellers, there's a high probability of price turning at the zone. In this example, our profit zone is $5, giving us a reward to risk ratio of 5 to 1. Not bad. This leads us to our third point: maximize reward. That vacuum of space provides a clear path for price to move to the target, maximizing our reward. These are the key ingredients to success. Now, when setting targets, you want to consider the reward to risk ratio it provides you. The reward on a trade is linked to the risk. Say you want to go long at demand at 10 with a stop loss at 9. That puts the total risk of the trade at 1 point. With a target at 11, you're risking $1 to make $1. And to be profitable, you'd need to win most every trade you make, maintaining a high winning percentage. Consistently aiming for a 1-to-1 reward to risk ratio is kind of a weak strategy and isn't realistically the formula for success. With a target at 12, this gives you a stronger ratio of 2-to-1 because for every dollar you could lose if the trade gets stopped out at 9, you now have the potential to earn $2 if you hit the target at 12. Now with the target at 13, this is the strongest reward to risk of these three examples at 3 to 1. By aiming for at least a 3 to 1 on each trade, it's possible to lose 3 out of 4 trades and still break even. That's 25% winning percentage. Just a little better than 25% and you're profitable. Now let's flip the picture and look at the supply side. Shorting at 20 with a stop at 21, your risk is a unit of 1. A target at 19 provides a 1-to-1 reward to risk ratio. While it would be difficult to achieve consistently great profits, a target like this could be used to offset risk when trading with multiple targets. With a target at 18, this bumps you to a 2-to-1 reward to risk ratio, risking $1 to make $2. But again, aiming for 3 to 1, in this case with a target at 17, is going to take the pressure off of you from having to be right all the time. Or just imagine pushing that to 4, 5, 10 to 1. With a 10 to 1 winner, you can be wrong 10 times before you have to admit it to your spouse. Just kidding. We do encourage honesty. But what you're doing is setting yourself up for success with little risk and high probability of success and the ability to maximize your profits. Now you have a basic overview of reward to risk ratios and their importance to your overall risk management. When you're considering a trade, make sure that the trade has a high probability of success. Next, think about the reward to risk. Within that ratio, we want first and foremost to consider the risk and the reward second. Proper risk management is understanding that successful trading and investing is about not losing money just as much as it's about making money. In this lesson, we'll explain target buffers and how to use them when setting targets for the trade. When placing targets, there are 2 boxes that need to be checked. First, make sure the trade pays you well. You'll decide on a minimum reward to risk ratio for your trades, but with at least a 3 to 1, you only need to exceed a 25% winning percentage to be profitable in your accounts. Second is the location of the target. Targets should be placed before an opposing zone because this increases the likelihood of price reaching your target and allows you to take your profits before the competitive buying or selling begins at the opposing zone. There are 2 ways to determine the target buffer. The first is to use a mechanical reward to risk ratio, and the second is by using a percentage of the profit zone. It's important to remember that when going long at demand, our target goes below the proximal line of the first opposing supply zone, and for a short at supply, the target goes above the opposing demand zone's proximal line. So let's look at each of those. First, let's calculate a mechanical reward to risk ratio. In this example, we're interested in going long out of a demand zone at the proximal line 2740. Subtracting the stop buffer from the distal line puts the stop loss order at 2690, below the distal line. Now we need to calculate the mechanical reward to risk ratio. We do that by first calculating our risk. 2740 minus 2690 means our risk is 50 cents. If we want to get a 3 to 1, then 3 times 50 cents is $1.50. In other words, we're risking 50 cents to make $1.50. Where is the target price then? Adding 150 to the proximal line of 2740 puts our target at 2890. Let's go back to those 2 checklist items for the target. 1, is it at least 3 to 1? And 2, is it ahead of the opposing target zone? By design, the target will be at the 3 to 1 mark, but we need to check that the target is below the opposing supply zone. Since the opposing supply zone starts at 30.40, 28.90 is below that, so we're golden. Next, let's take a look at the same example, only this time we're going to use a percentage of the profit zone as the target buffer. With entry at 27.40 and the proximal line of our target zone at 30.40, we see here that the difference is $3, the profit zone. Next, using 75% of the $3 profit zone, this sets the target at 29.65. In this case, the target will be set ahead of the nearest opposing zone, but what we need to make sure of is that the trade has a proper reward to risk ratio. When you first heard of set, you probably thought that sounds simple enough. Well, as you can see, there are a lot of components which must be thought about. In this lesson, we dove deeper into set by looking at the stop buffer, the implementation of different order types, reward to risk ratio analysis, and the target buffer. While this may be a little confusing now, with a little practice, it will become second nature in no time. Now you know what a target buffer is and the different ways we can calculate our target. This wraps up the set portion of planning out the trade, the stop, entry, and the target. And the final consideration before sending off your order to the exchange is determining the correct position size. We'll look at that in our next lesson. In this lesson, we're going to dive deeper into gaps. So what exactly is a gap? A gap is essentially the space left between the closing and opening prices of two different candles. Typically seen on daily charts, gaps tend to reflect the imbalance between supply and demand, or buyers and sellers. The greater the gap, the greater the imbalance. Although gaps can create additional risk for open positions, they can also play a role in helping us identify opportunities if we know what to look for. A gap can represent the strongest picture of supply and demand imbalance. Which of these three gaps in the example show the greatest imbalance? Looking at number 1, we see there's virtually no space between where price closed on the green candle and opened on the first green candle that left the zone. Looking at number 2, we again see very little movement or space between where price closed on the green candle and opened on the next candle where price moved out. Looking at number 3, however, we see a big space between where the green candle on the right of the base closed and the next candle outside the base opened. The gap between these two candles represents the greatest imbalance of these three examples. Why is this so important? Well, if we had these three possible trades lined up, which one shows the greatest imbalance? It's clearly number 3 because there must have been a big imbalance in price to cause such a wide gap, and therefore we can use that to our advantage next time price retreats to this level. In this lesson, we reviewed gaps. Gapping is an important concept that can not only help you identify imbalances between buyers and sellers, but also create some excellent opportunities when it comes to placing trades. In this lesson, we'll explain inside gaps and show you how to identify them on a price chart. An inside gap occurs when price opens between the range of the high and low of the prior candle. Inside gaps tend to represent a corrective move where the next candle moves in the opposite direction of the prior candle. In the example to the left, we see a large red candle which closed near the low. The next candle is a smaller green one which opens within the range of the previous candle. This results in a small gap up, which we would call an inside gap. In the example to the right, we see a larger green candle followed by a smaller red candle. Again, the red candle opened within the range of the green candle, showing a gap down, which we would also classify as an inside gap. If the inside gaps are located in quality opposing supplier demand zones, they tend to fill fairly quickly. Let's look at an example. This is a 5-minute chart for QQQ. First, identify the range of the previous daily candle, putting 2 lines on the chart, one at the prior day's high price and one at the prior day's low price. Within this range, we see several 5-minute candles. Looking to the right, where the gray box ends, we see that a gap has formed. The red candle opened inside the prior day's range, but it also opened below where the prior green candle closed, creating an inside gap. Shortly thereafter, as we see in the example, the gap gets filled in, what's referred to as a gap fill, which, as you've just learned, is typical of inside gaps with quality supplier demand zones. In this lesson, you learned about inside gaps. As you identify them on charts, pay attention to how price reacts to these gaps to get a better feel of how the markets respond to different types of gaps. In this lesson, let's look at the outside gap. An outside gap occurs when price opens above or below the range of the prior candle. Outside gaps also tend to reflect momentum or exhaustion, especially if moving in the direction of the trend. In the example to the left, we see that the second green candle opened higher than the close of the previous candle. Opening outside the range of the prior candle makes it an outside gap. In the example to the right, we see a smaller green candle known as a doji, followed by a red candle. The difference between where the green candle closed and the red candle opens defines the gap down. Since the open of the red candle is outside the range of the prior green candle, it's an outside gap. With outside gaps, sometimes price moves in the direction of the prior candle and sometimes it moves in the opposite direction. It's also important to note that outside gaps don't tend to quickly fill like the inside gaps do, and they often represent a trend continuation. Let's look at another example. We're looking at a 5-minute chart for QQQ. First, we identify the range of the previous day's daily candle, so we put 2 lines on the chart, one at the prior day's high price and one at the prior day's low price. We see that this red candle opens above the prior day's range, confirming this to be an outside gap. We also see that the red candle opened higher than the close of the prior day's red candle, making it a continuation move. It's important that we become comfortable identifying inside and outside gaps. Look closely at these candles going from the far left to the right side of the chart. See if you can identify, based upon candle to candle, whether each gap would represent an inside or outside gap. Remember, with inside gaps, we see the next candle's price open within the range of the previous day's candle. And with outside gaps, we see the next candle open outside the range of the previous day's candle. In this lesson, we talked about outside gaps. Gaps can represent significant imbalances in supply and demand, which may present some great trading opportunities. In this lesson, we'll take a closer look at trade management. Once a trade is open, it's important to follow your plan to manage the trade strategically. One way to help achieve profitable trading is to have a proper trade management strategy. This may be as basic as doing nothing and simply letting your trade play out. Many people overthink things or get very emotional, which gets in the way of their trades. That's why it's important to remember that while you're in a trade, it's okay to move a stop in the direction of your profits in order to help you lock them in. At the end of the day, however you choose to manage your trades, the combination of winning percentage and your average reward to risk is what gives you a positive P&L or not. Whether going for greater profits per trade with a lesser winning percentage or going for a greater winning percentage with maybe a little less profit per trade, either work. Just be consistent in how you manage trades to achieve those targeted values. A powerful tool for trade management is a trailing stop. A trail stop is designed to follow price as it moves in the direction of the trade. If you're long, a trailing stop will only move up, locking in profit as price moves in your favor. And if you're short, it will only move down to lock in profit. There are two types of trailing stops. They can be automated to move as price moves a certain amount of points or percentage in the desired direction. And the other way is a manual technical trailing stop, where you would periodically adjust the stop placement based on supply and demand and trend. Here's an example of a manual technical trailing stop with a demand zone. We already know to set an initial stop below the demand zone using the stop buffer. The rule says when qualified demand forms, we simply move the stop up below the new zone. Here we see that price has left the initial demand zone. We can see the trend continuation since price created a new higher high that broke previous supply. Once we see that, we move our stop loss up just beneath the low of that new area of demand. We follow the trade as it keeps going higher, and once we have another breakout taking out supply, we move the stop again below the distal line of the new demand area. We keep doing this over and over as the trend continues, moving our stop accordingly and locking in profit as we earn more and more on the way up until eventually the trend terminates. That's where price falls below the controlling swing low, where we place the stop and the trade is stopped out for profit. We use the same process when looking to short out of a supply zone. The initial stop goes above the distal line of the supply zone using a stop buffer, and when new qualified supply forms, we move the stop down above the newly formed zone using the same stop buffer. In the example, price moves out of the initial supply zone and breaks the lows. Once those lows are broken, the stop moves down to just above that area of new supply. As with the demand example, we keep looking for these trend continuations that confirm price wants to go lower by breaking previous demand, while at the same time moving the stop lower, helping us lock in profit on the way down. As long as we have quality supply zones, we move our stop loss lower, until eventually sentiment shifts and price rallies and terminates the trend, and in doing so, we're stopped out for profits. In this lesson, you learned about trade management. As a part of that, you learned about trail stops and when it's appropriate to move your stop order. It's important as part of your trade management plan to have the opportunity to remain in a trade beyond a set 3-to-1 reward to risk ratio to cushion your account even more. However you decide to manage your trades, just remember that it's the combination of probability or winning percentage and profitability, reward to risk, that make you successful or not. In this lesson, we'll take a closer look at monitoring reports. Monitoring reports falls under the category of managing your trades. Most financial news is scheduled far in advance. These reports tend to be released at different times, daily, weekly, monthly, or even quarterly. This news can also be released before the market opens, during the market session, or after the market closes. These news events affect people in different ways, but professional traders and investors must be willing to manage their risk, knowing market sentiment can change based off these reports. When high-impact reports come out, You need to be ready and able to make changes in your trades, either by delaying a trade you're not already in, or if you're in a trade, making some adjustments. How? You could use a trailing stop, either automated or manual, to move your stop loss order closer to the current price to lock in that profit. Or another way to manage the trade is by reducing your position size around the release of the report. Maybe you sell off some of your shares, contracts, or lots before an announcement is made. The safest option is to close your position entirely, take your profit, and move on. Or you could use other types of assets, such as options, to hedge when a high-impact report is released. An option could protect you in the case of these announcements causing the stock price to change significantly. Before doing that, however, make sure you learn about what options are and how to properly use them. Not doing so could lead to big losses, but just know that hedging a position with options is a possibility. Hopefully, you can now see why it is so important to monitor reports before, after, and especially during any trade you make. As a trader, it is important to be aware of any catalyst that might have an impact on your trades. News, earnings, events, announcements may have a massive impact on price or none at all. What you will learn as you progress as a trader is which reports have more of an impact on the securities which you trade. Tracking actions as a trader is a very important step for continued development and progress. In this lesson, we'll show you how to log trades. Once a trade closes, your next step needs to be to log the results of the trade. Why is it important to log your trade? You may have heard the famous business quote, "What gets measured gets managed." Logging your trades is a way of measuring your trading activity, which in turn helps you control or manage the outcome of your trading activity. Logging your trade provides you with a record of how the trade transpired, which you can go back and analyze later. Capturing your results and then analyzing them is key for improving in any area of life, as it helps you gauge whether you're successful or not, and most importantly, why. It's a good idea to get in the habit of logging your trades as soon as they close. You can use any tracking application or tool you have. It's helpful to categorize by rows and columns so you can easily filter and sort to better analyze the results. Consider keeping a picture log. Trading is so visual, and it's helpful to take a screenshot of your trade in order to see exactly what the setup looked like. You can also begin to log the trade as soon as it opens and update it once it's closed. What should be included in a trade log? First of all, the ticker symbol. The sets, the entry, stop, target, and position size, whether it's a long or a short, the entry price and the exit price, as well as the dates and times of opening and closing the position, whether it's a win, loss, or break even. What was the targeted reward to risk, and what was the actual reward to risk? What were the profits earned or loss incurred? The time frames used or the trading style? What was the odds enhancers score? This list isn't exhaustive, but it's a good start. Maybe you want to add the trend direction and curve location as their own columns, then add it in. As you begin to track your trades and review your results, you'll come up with more things to include that you want to track. You should also keep a running measure of a few metrics. Things like your winning percentage and your average reward to risk ratio based on your average profit per trade and average loss per trade. Remember, it's this combination of winning percentage and reward to risk that makes you profitable or not. Track your rate of return. the number of trades taken, and the total account balance. Again, this isn't exhaustive, and you could include more things like the duration of your trades, how long do they take to close. You would also want to keep a separate trade log for each asset class you trade. Or maybe you apply different strategies or indicators and you want to track those. Here's an example of what a trade log might look like. You'll notice it includes the sets, all the times and prices of entry and exit. It includes the result, win, loss, or break even, the profit or loss, the targeted reward to risk and the actual reward to risk. And also notice all the metrics this includes, like the total number of trades, the winning percentage, the average reward to risk, and the account balance. If you enter some data, you see what a filled-in trade log looks like and what the resulting metrics look like. Notice that with a 30% winning percentage, the account is in the positive. How is this possible? With proper risk management. Of course, you want to improve your win rate always, but see the power of keeping your losses small and your wins big. So now you know what a trade log is, how important it is, and some ideas of what to include in your trade log. Get in the habit of logging your trades in a timely manner. In this lesson, we're going to discuss an important element of your trading plan, reviewing your trading results. In order to review results, it's important to always log your trades so you have some results to review. This review process is the final piece of the trade plan blueprint. Reviewing your results helps you determine whether you're reaching and maintaining your financial and trading goals. If you find that you aren't, then you definitely want to use this information to identify your current weaknesses and work towards addressing them. For short-term income trading, you should review your results on a weekly to monthly basis. And for long-term wealth investing, you should review your results on a quarterly to annual basis. In a perfect world, if you took 10 trades, you'd win all 10. You'd have no losers and see a nice big curve to the upside representing profit. Sadly, we don't live in a perfect world. In fact, most people live in a novice world. Their P&L curve looks something like winning 8 out of the 10 trades, but the 2 losers are so big and the overall result is a loss, even though 8 out of 10 trades were profitable. Novice traders simply don't understand how the reward to risk ratio works. We want the professional traders world where we could actually lose 6 out of the 10 trades and still see a profitable curve. How is this even possible? Looking at our sample trade log, we can see a total of 10 trades were taken. We only had a 30% winning percentage. That seems too low, right? And yet, the account is overall profitable. How's this possible? Because of proper risk management. We have an average reward to risk of over 7-1. That's amazing. It's important to periodically circle back and review your results. If you're taking the trades dictated by your trading plan, maintaining your targeted reward to risk ratio, hitting the winning percentage you require based on that ratio, and you're profitable, then hey, you're doing great. Reviewing your results is key to helping you focus your activity, refine your decision making, and ultimately improve your skills. In this lesson, you learned the value of tracking your trades and reviewing your results. Unfortunately, many traders do not log their trades, let alone review their trades. They measure success as just profit or loss. But as you can see, by reviewing your trades, you can focus on what is costing you money, modify your plan to address these problems, and increase your chances of success. In this lesson, we'll explain the significance of having a trade plan. Why is it so important to have a trade plan? Well, because as traders, we need to learn to manage our trading like a business. Imagine having a business and trying to watch it grow and succeed without some type of clear and consistent plan. Succeeding with no plan is called luck. Your personal trade plan helps you define your purpose, goals, and strategy. It also helps you project revenue and expenses. And most importantly, your personal trade plan helps you track your skill development. Let's start with the trade plan blueprint, which outlines the key elements necessary to set up a trade or investment. A trade plan essentially formalizes and personalizes these various elements. There are several questions you need to ask yourself to determine what type of content to include in your trade plan. 1. Why do I want to trade? This is where you start to define the reasons why you want to become a trader or investor. For this, it's important to look beyond the generic, I want to make money. Focus on your why and what drives you. Come up with a personal mission statement. 2. Who am I as a trader? In this area of the trade plan, you get to focus not only on your strengths and weaknesses, but more importantly, how do you overcome your weaknesses when it comes to your trading? 3. What type of trader am I? You might want to be a short-term income trader or a long-term wealth investor, or maybe both. Determining what type of trader you are helps you hone in on the kinds of trading you'll be utilizing, from trading on multiple time frame charts or how long you plan to even be in the trades. 4. In which markets will I trade? This is where you get to decide whether you'll trade stocks, futures, foreign exchange, options, or any combination thereof. At this point, you may not know which assets you want to get into, and that's okay, but start with a vision of where you'd like to go with your trading. 5. What are my financial goals? Figure out how much money you're looking to generate on a daily, monthly, or even annual basis. 6. When do I trade? It's important to define in advance what times of the day or week you plan to dedicate to your short-term income or long-term wealth trading and investing. This will help you schedule your trading around anything you might have during the day, such as a job or other prior commitments. You need a consistent time of day that can dedicate specifically to your trading. 7. How does your trade strategy work? Your trade strategy can include everything from analyzing the markets to placing the trade, to getting filled and managing the trade to an exit, including how you're going to log and review it. 8. How will I manage risk? Understanding your trade strategy helps you learn to manage your risk in order to continue to grow your account. You're also going to develop your personal risk management rules, addressing what your maximum acceptable loss is on a daily, weekly, or monthly basis. 9. What trade log and feedback mechanism will I use? When you start tracking your trades, decide how frequently you're going to analyze the trades using your trade log in order to determine areas that need improvement. A trade log is critical in helping you understand what you're doing wrong. Once these issues are identified, you can work to eliminate those mistakes. And 10, what trading education will I need? You have to determine how to continue investing in your education to continue developing your skills as a trader. There's a classic phrase in the market that states, plan the trade the plan. It's an important quote because many traders shoot from the hip, doing things differently on every single trade. If you do things differently each time, how can you ever hope to achieve consistency? By having a plan in place and following your rules, you can quickly identify what is working and what is not. This makes it easy to fix or eliminate what's not working. By now, you can see the significance of having a trade plan. Just as you would have a map to help you find your destination when traveling, you should have a map for your trading goals, and that map is your trading plan.